Hello friends, good morning to all of you. Hello guys, good morning to all of you. I hope you all are doing well. Today is Sunday and we are having a session on financial instrument. As of now, I think 44 people have joined. Hope you guys had a reading of what we have read yesterday and gone through the Infosys financial statement. Yes or no? So any doubt guys for yesterday class? Any doubt, anything which you think seems to be not so clear? Ashu is saying no. Very upfront answer, no doubt. Okay, that's looking very strange. The people had a 4.5 hour discussion yesterday and we don't have any doubt on financial instrument. Strange. Any doubt guys? Ashu is saying everything explained very nicely. Okay, thank you so much Ashu. So guys, it's almost 10. Should we start? I think out of 150 people, 63 people have joined. I'm not sure if we start, they will lose something. And if anything gets missed, it's very difficult to regain. Let's wait a couple of minutes, guys. Only 70 people have joined. Around 50% people have joined out of 150. Any doubt? Anyone has having any doubt what we have read yesterday? Any doubt? Happy to answer. Raju is saying Sunday effect. Okay. Sometime no means all clear. Ha ha ha. On a lighter note, indeed, it was a good session and most of the things were clear. Okay. That's good. Okay, guys. So let's devote 10 minutes, right? What we have read yesterday, right? Around, let me see how many people, 79 people have joined, right? So let's devote 10 minutes to understand or to recap what we have read yesterday. In the meanwhile, more people will join. Okay, so yesterday class, what we have said, globally the standard is applicable from 1st January 2018, but in India we have adopted this standard from 1st April 2015. That means prior to the global application, we were not having any precedents, and India has adopted first time in the globe this standard without any precedents. And not only adopted, we have successfully applied and adopted the standard in India, right? So we said, what is financial instrument? Standard setter has taken two words, combined those two words and developed a 250-page document, which is Ind AS 109 on IFRS 9, right? So what we said, what is financial instrument? Financial means instrument. Financial means anything which is denominated in a monetary value, and instrument means a contract, right? What we have said yesterday, a contract which is denominated in a monetary value is called financial instrument. What is contract? We have already read the contract in Indian Contract Act. No need to read something more which is not required, right? So contract, two or more parties, enforceable by law. It can be verbal, it can be written, and it can be implied, right? So what we said, any contract entered between two or more parties which is denominated in a monetary value is called financial instrument, right? Then we took one example, sale and purchase or debtor and payable, right? In which we said A has sold 1 lakh rupees goods to B and B has to pay 1 lakh rupees back to A in consideration. For A, it is a financial, it is a trade receivable. This trade receivable is an asset and that asset is denominated in a monetary value. And we said it is a financial asset. For B perspective, we said it's a trade payable, which is a liability, and this liability is denominated in a monetary value. Hence, it becomes a financial liability for B. That means for one party, it is a financial asset. For another party, it is a financial liability. Then we took another example, investment in shares. Right, for one party we were saying for A Limited it is an investment asset and this asset is denominated in a monetary value, hence it becomes a financial asset. And for another party it is not actually a financial liability, it is an equity, because what accounting entry we will pass? Bank account debit to equity share capital. So for one party it is a financial asset, for another party it is an equity. Then we combine these two examples and we said any contract entered between two or more parties which give rise to a financial asset of one entity and either a financial liability or equity of another party, it is a financial instrument, guys. Right, this is what we have discussed. Right, then we said for financial instrument there must be a contract, two or more parties, monetary value, only then we say it is a financial instrument, otherwise we will not say. Right, then we reach to financial asset, or we prepared this diagram. Financial instrument, we have financial asset for one party and financial liability or equity of another party is a financial instrument. Right, financial asset, what we said? Cash. Cash is a financial instrument. Cash is a financial asset. Second, investment in shares. Third, contractual right to receive cash. If I'm having a contractual right to receive cash or bank, then it is a case of financial asset. We took certain examples. For example, trade receivable. For example, security deposit paid, which is to be refundable. Loan given, which is to be refundable. Right? What else? Any other receivable, right? Those are considered to be a financial asset. What is not a financial asset? PPE, inventory, intangible, goodwill, right of use asset, deferred tax asset, income tax paid, advance tax, any taxes paid have been excluded. Right, advance given, which is to advance given to the vendor, which is to be adjusted against the goods or services, that has been excluded, because I'm expecting to receive the services, I'm expecting to receive the goods but not cash. But if in future that contract gets cancelled and my advance which I paid earlier, that becomes refundable, then it's a case of financial instrument and financial asset. We took one example, one query has been raised yesterday in respect of unbilled. We said unbilled is of two types as per Ind AS 115. Unbilled, where the performance obligation is over, then it will form a part of trade receivable. Where it is written? It is written in Ind AS 115. And if it forms a part of trade receivable, it is a financial asset. Right. Second point, unbilled revenue, where unbilled revenue, the performance has not been over, then it will form a part of contract asset and not trade receivable, and hence it is not a financial asset. Right, this is what we have discussed. Then we said, what is financial liability? What is financial liability? Contractual obligation to pay cash or bank is a financial liability. What can be the example? Borrowings, lease liability, loan taken, security deposit I have received. Right, so these are financial liability. What is not a financial liability? For example, deferred tax liability, income tax liability, GST liability. All these things are not a financial liability. Right, then we said, what is equity? We read in class 11 the equity, the same definition which we have read in class 11. It's given under IFRS 9, is given under Ind AS 109. What is the definition? Residual value in the total asset excluding liability is my equity. What is this? Total asset minus liability is equal to equity. This is what we are reading since class 11th. Right, second definition of equity is when there is no liability. Right, when there is no contractual obligation to pay cash. Third one is settlement through own equity shares. This is what we are going to read today. What do you mean by settlement through own equity shares? Right, then we said very important aspects, classification. What is classification? Financial asset is divided into three classification: amortized cost, fair value through OCI, FETPL, fair value through PNL. What is amortized cost? Two condition. What is amortized cost? Opening balance, transaction during the year plus any interest minus any bad debt minus any collection is equal to amortized cost. If someone asks you what is amortized cost, it is nothing but a closing balance which we compute under Indian GAAP, where except one thing. What is that one thing? Interest is to be computed based on effective interest rate method. Right? What is effective interest rate method? ये वही method है which we have read in class 11th. Amount is equal to principal bracket 1 plus r to the power t. The way we used to compute the discounting, the way we used to compute the discounting or the present value, the same methodology we use under IFRS 9 or Ind AS 109. Right? Then we said when an asset is to be classified at amortized cost, when two conditions get satisfied: business model test to collect and SPPI. What is business model test to collect? The intention or the business model of the company is to hold the asset till the end of the maturity period. We took the example of debenture. I invested in Bharti Airtel for 10 years, 10% rate of interest. When I will get my money after 10 years, that is a case. When my intention is to collect my money after 10 years, that is a case of business model test to collect and sell. Right? Then we said, what is SPPI? Four condition: principal must be there, interest must be there. Interest can be any percentage. Interest can be fixed or floating. Principal interest shall not be linked to any equity price or any other index except inflation. Why inflation we are excluding, or the standard is excluding? Because index is generally based on inflation. If the inflation is going on, in the economy, index will keep on improving. Right? So the standard setter has linked the index with the inflation, but not any other thing. Right? So this four principle is nothing but a basic lending arrangement. What is basic lending arrangement? When you go to the bank to take a loan, right, in that case there is a principal, there is an interest. Interest can be fixed or floating. In that case, your principal and interest is not linked with the equity price of any other company or any other index. That is why SPPI principle or test is also called a basic lending arrangement. Right? Then we said, what are the example of amortized cost? Trade receivable, investment in debenture, investment in preference shares, investment in bonds, not preference shares. Right? Shares, investment in shares are always excluded from the amortized cost concept. Right? Then we said FET OCI. What is OCI? Notional accounting, notional change in the fair valuation, which is notional, to be parked in OCI. Around 12 to 13 items needs to be recognized on OCI. Yesterday we took the example of around 10 items. Right? Items which is to be reclassified to PNL, item which is not to be reclassified in PNL. Right? Then we said, what are the conditions? Business model test to collect and sell. The word sell has been added here. What is the meaning of this? Where the intention or the business model is that I will not hold the asset till the end of maturity period. In that case, business model test to collect will get fail, and business model test to collect and sell will get satisfied. For example, I invested in the Bharti Airtel debentures 1 lakh rupees, 10%. Right? Business model is that I will sell after 6 years. I will collect my money from Airtel. I will invest into some different business opportunities. In that case, business model test to collect and sell will get satisfied. Second condition, SPPI is common. Right? Same condition. If SPPI is common and SPPI gets failed, then my last answer is FETPL, which is fair value through PNL. Right? Fair value through PNL. Right? What is fair value through PNL? That means if an asset is to be assigned at FETPL category, every time that asset needs to be fair valued, and the change in the fair valuation will be routed through PNL. Right? We said this is a residual category. If any investment is held for trading, then it's a case of FETPL. Right? This is what we have discussed. And very important aspect we have discussed yesterday, irrevocable exemption. Right? What is that? If I have invested in the equity shares of my subsidiary, associate, joint venture, if I invest in the equity shares of Bharti Airtel, if I invest in the equity shares of Reliance, any other company, listed, unlisted, that means investment in equity shares. Right? Investment in equity shares, then what will happen? It will fail SPPI because it is linked to the share price of the company. That means I cannot classify it, my investment at amortized cost. I cannot classify it at FET-OCI. But an exemption has been given only for the FET-OCI category, that in that case, the company has a choice that that investment can be recognized either at FVTOCI category or FVTPL category if it is not held for trading. That investment choice is available to the management. That investment is choice is available on investment by investment basis, right? What is that? Investment subsidiary 1, FVTOCI, investment subsidiary 2, FVTPL, investment subsidiary 3, FVTOCI, and so on. That is what the choice investment by investment meaning, right? Then we said FVTPL residual category, derivatives, investment held for trading, all those stuff. Then we said financial liability, very simple, amortized cost, FVTPL, no condition attached to amortized cost as compared to financial asset category, right? What is the default category? That means except for the example of FVTPL derivatives held for trading, everything needs to be classified at amortized cost. How to compute amortized cost of a loan? Opening balance of the loan plus loan taken minus repayment plus any interest minus any bad debt. In case of loan, there is no bad debt, right? From the company perspective, not from the bank perspective. That is way that is way we will compute the amortized cost of the financial liability or loan, right? And how the ER is to be computed, we will understand today how the EIR is to be computed in case of amortized cost in case of liability. Yesterday we took the example of security deposit, and we understood how the effective interest rate is to be computed in case of financial asset, right? Today we will understand how the effective interest rate is to be computed in case of financial liability, correct? Then we said equity, no classification, right? After this, we discussed measurement principle, measurement, initial recognition, thumb rule, everything needs to be recognized at fair value. Subsequent recognition, as the name of the category suggests. What does it mean? If it is amortized cost, then subsequent recognition will be amortized cost. If it is FVTOCI, then fair value. If it is FVTPL, then fair value. If it is amortized cost, then amortized cost. If it is fair value through P&L, fair value. And there is no subsequent remeasurement of equity. Equity needs to be recognized only at once, right? Then we took the example of security deposit received, in which we said that on day one we need to do the discounting because I need to recognize my financial asset at fair value. That security deposit yesterday was not at fair value. 1 lakh rupees was not the fair value. Why? Because I'm supposed to receive 1 lakh after 3 years down the line. So we said the value, the present value of 1 lakh rupees comes out to be 75,000 rupees, and balance 25,000 rupees we have assigned it to the prepaid rent, right? So why prepaid rent? We said it's a relationship between lesser and lessee. जिस चीज की वैल्यू 75,000 होनी चाहिए थी, I have actually ended up paying 1 lakh rupees. Why? So it is deemed, उसको मान लिया जाएगा ये जो additional मैंने payment करी है, that is nothing but a prepaid rent. And what is the accounting treatment of prepaid rent? Accounting treatment that will be assigned as a part of ROU, and going forward it will be charged to P&L. And on security deposit I will be charging interest. How to compute interest? Apply the same 11th class mathematical formula of annuity chapter, right guys? So I think we have summarized everything in 15 minutes what we have read in last 4.5 hours. Any doubt so that we can move ahead? Yes or no? I hope guys you are attending the session. Okay, so let's discuss couple of more questions guys, right? For 1 hour at least we should be discussing couple of more questions, because that will set the benchmark what we have read yesterday and what accounting needs to be done. And believe me guys, if you are clear with the classification part, 50 to 60% of the standard is in the grip, right? We need to read a couple of additional information or concepts, but 50 to 60% of the standard in the grip, right? Okay, so we will be discussing couple of more questions today, right? And I will name these questions as a benchmark question, right? So whenever you have to do the accounting in the practical ground, right? You can take a reference of all these questions. We will going to take up around 3 to 4 questions. One question yesterday, which is security deposit accounting, right? Practically we name it like this, right? If I need to do this accounting, I tell my team members, boss security deposit accounting जो होती है वैसे accounting करनी है, employee loan की accounting जो होती है यहाँ पे वैसे accounting करनी है, right? So we keep on using these words on a practical ground. right? So first thing what we have learned yesterday, security deposit accounting, where the differential is to be parked in prepaid rent. Okay guys, okay. Now let's take another example. A Limited has given a loan to its employee, right? A Limited has given a loan to its employee, right? Amount is 1 lakh rupees, right? This is for the period of 3 years, right? And I'm assuming that this is to be repaid after 3 years. Repaid after 3 years, right? Now guys, you have to tell me what is the Indian GAAP accounting in this case. Quickly guys, quickly. Right? So A Limited, we are doing the accounting in the books of A Limited. So what the A Limited will say, loan to employees to bank, 1 lakh rupees. Correct? Okay. What will be the second accounting? After 3 years, bank, let's say this is interest-free loan. Some companies charge interest, some companies doesn't charge interest, some companies charge below market rate of interest, interest-free loan, right? Since we are doing the calculation manually here, to ease the calculation, I'm just considering this interest-free loan. Bank account debit to loan. Amount is 1 lakh, right? Okay, guys. Now tell me, we need to evaluate under Ind AS, right? Hope this is visible to you, right? First, tell me, is it a financial instrument for A Limited? Yes or no? Yes, this is financial instrument. Then, is it a financial asset? Yes, it is a financial asset, right? Then I need to evaluate classification, amortized cost. I need to do the evaluate the classification. What is about business model test to collect, right? The objective of A Limited is to collect his money after 3 years, right? Business model test will get satisfied. Then SPPI. SPPI principal exists. Yes. Interest exists. Yes. The rate of interest is 0%. Interest can be any percentage. Interest can be fixed or floating, right? In this case, interest, in this case, principal and interest is not linked with the equity price of any listed or unlisted companies. Principal interest is not linked with the any index, right? So in that case, we will say SPPI will get satisfied. This will be recognized at amortized cost, right? Initial recognition, fair value. Subsequent recognition, amortized cost. Evaluation clear hai? How do we need to do the evaluation? Every time for each and every transaction? Yes or no, guys? Okay. Now tell me, guys, what is the first accounting entry under Ind AS? What should be the first accounting entry under Ind AS? Loan to employee, loan to employee, and to bank, right? This is on day 1. Amount is I have paid 1 lakh rupees and now I am going to receive 1 lakh rupees after 3 years down the line in a single bullet repayment, right? Without any interest. Now, can you tell me what is the amount which I should write in the value loan to employees? And let's say Discounting rate is 10%. I'm taking the same numbers so that we can compare the question number 1 with the question number 2. Can you compare? Can you compute the present value of this 1 lakh rupees? One person is saying, Akhilesh is saying loan to employees is 72,900. So my sense is it should be the same number which we took yesterday, 75,000 something. Yes, people are saying 75,131. 75,131. What is the differential? 24 something. So 1 lakh minus 75,131, 24,869. Right? Okay. Now guys, tell me where should I park this 24,869? Nirav is saying, sir, again I will pass this amount in a prepaid rent. My dear friend, हर बार prepaid rent नहीं आएगा. हमने क्या कहा था? When it should be a prepaid rent, we need to evaluate the relationship. Right? Is the relationship in the nature of lessee and lessor? No. No. Couple of people are saying interest receivable. Right? Couple of people are saying employee benefit expense. So it is actually an employee benefit expense, but it is not an expense on day one. It is not an expense on day one. Yesterday, that 24,000 was not an expense on day one. Yesterday, we took that it is an expense. It is an asset on day one. It is a prepaid asset. It is a deferred asset, right? Similarly, we will say it is a deferred asset again, right? And what is the nature of this deferred asset? Employee benefits. Perquisite. Deferred asset बोल लो, prepaid asset बोल लो, deferred employee benefit asset बोल लो, right? But it is in the nature of deferred asset, which is to be recognized in the balance sheet in asset side, and the nature is pre-employee benefit, right? Whatever name you call it, but it is in the nature of deferred benefit to employees. Correct, guys? I hope there should not be any confusion in this, right? Okay, after year one, what should be the accounting entries of this deferred asset? Let's deal with deferred asset first. What should be the accounting entry? Year 1, 2, and this is 3. Year end. Right? Now guys, tell me what is the accounting entries? First accounting entry, P&L debit, right? P&L debit, employee benefit. Employee benefit expense to deferred asset. What is the amount? 24,000 divided by what? 24,869 divided by 3. So this will be no entry on day one, year one, 8289 or 8290. Right? 8290. Should I record the same accounting entry for every year end? Yes. Correct. Now guys, tell me what is the next accounting entry? What is the next accounting entry? This is my financial asset. This is my financial asset. I need to recognize this financial asset subsequently at amortized cost, right? So what I need to do, I need to book interest income, sorry. Loan to employee to P&L, interest income. Can you guys compute what is the interest income for the year one? Can you guys quickly compute what is the interest income for year one? 75,131 multiplied by 10%. Very simple. 7513, right? Can you compute for year two? 8264. Okay. And for year 3, 9091. Right? The total of all these three numbers should be coming to 24869. Let me check whether it is actually coming or not. 8264 plus 9091. 24868. It should be 2. Right? And the total of this number should also be coming to 24869. 24869. 24869. Let me check. 8290 into 3. 24869. It should be 89. Rounding of difference of rupees 1. Right? And after finally, I will get my bank account. बैंक में कितना आना है? बैंक में तो मेरे को 1 लाख रुपए ही आने हैं. And when? At the end of year 3. Right? So guys, this will be the accounting entries which needs to be passed in the financial statement of a company if the loan is given to the employees, which is free of cost. Right? Let's evaluate these accounting entries. This is okay. Then what will happen? There is a notional expense in the P&L every year basis. Right? Similarly, there is a notional income in the P&L on every year basis. Right? The total of these expense and the P income over the period of 3 years is equal. That means P&L will be equal. P&L will be neutral over the period of 3 years, but every year basis there is a delta. Right? In the first year, expense is more. In the second year, expense is slightly more, maybe 20-30 rupees. Right? In the third year, income is more. Right? ICI has issued a guidance, as we discussed yesterday. All these notional income and expense are not deductible, are not taxable under Income Tax Act. But if the MAT is applicable to that company, we will start from PBT, and this amount will get expensed or deductible or taxable. Right? Because there is no consequential amendment has been made in MAT computation. Right, guys? And finally, we have got bank account debit to loan. So these will be the scheme of accounting entries on the every year basis. Okay, one person is asking, who is asking this question? Gagandeep is asking, sir, what about DT and DTL? So very good question he has raised. So we need to create deferred tax asset as well as the deferred tax liabilities on the disallowances and the allowances in the income tax computation. So here these two things are not deductible and not taxable. Right? So we need to create deferred tax on this numbers as well. Right? Okay, couple of people are asking, sir, if there is a nominal interest, then what will happen? Okay, guys, let's evaluate. It's only a mathematical calculation. So let's say they are charging 4% as interest. Right? They are charging, this company is charging 4% at interest on an every year basis. तो क्या होगा? Right? My this number will get changed because day one पे तो मैंने bank account 1 lakh ही दिया. Right? How to compute this number? I need to compute the present value of this number. I need to plot cash flows. How do I need to plot the cash flows? Year 1, year 2, and year 3. Right? Principal amount which is to be refunded. Right? I will get 1 lakh rupees here. I will get interest as well on every year basis, which is 4%. So 4% means 4,000 rupees, 4,000 rupees, and 4,000 rupees. Total cash flows 4,000, 4,000, and 1,04,000. Can I apply the present value factor here at the rate of 10%? I will get present value. So this will be my present value in this case. Right? So obviously this amount will be higher than 75,000. So my deferred asset amount, that means the benefit I'm passing on to the employee, will get reduced. And since it will get reduced, the same accounting entries will follow. The amount keeps on changing. Am I clear to you? Am I clear to you guys? Yes or no? Any doubt in this? Any confusion in this? Okay, one person has raised a doubt. What should be the basis of discounting rate and can it be changed in the second or third year? I think Lakshay has raised this question. Lakshay, I have very well answered this question yesterday itself. Can any one of you guys answer to Lakshay on this question? So Hiral is saying it cannot be changed. This is a partly response to your question. What about the basis of discounting? Can anyone tell him what is the basis of discounting? How should we take this 10%? Correct. People are saying lending rate of the bank. People are saying FD rate as well. So Lakshay, if you are doing the discounting from the asset side, you are supposed to take asset FD rate which you will get from the bank. If you are taking the loan from bank or you are doing the discounting here, then you will take the incremental borrowing rate. What is incremental? The rate at which you are able to take a loan from bank. That is what the incremental rate, right? I hope guys this is clear. So we have actually discussed in one particular question, we have discussed two things. One is if it is an interest free loan, and second is if the nominal rate of interest is charging or a rate which is lower than the market rate, right? So we have discussed three questions till now: security deposit accounting, interest free employee loan accounting, below market rate of interest accounting to employees in case of loan to employees. Are we all clear on the three questions? Yes or no? Can I rub this? Okay, very good. And I am hoping guys you are preparing your coaching notes parallelly. Okay guys, so we have discussed three questions. This is the question number 4. A limited, this is B limited. A limited has sold goods to B of rupees 1 lakh and B has to make the payment to A limited after 2 years. Let's change the question. After 2 years, B has to make the payment. That means the credit period is 2 years. Clear? I hope the question is very simple. A limited has sold the goods to B of rupees 1 lakh. B has to make the payment after 2 years, right? The credit period is 2 years. Okay. Now guys, tell me what is the Indian GAAP accounting here on day 1? What should be the Indian GAAP accounting on day 1? Vikas has raised to one question, sir. Is it possible that the interest rate is higher than the discount rate? Then we need to book an interest income. So discount rate will always be a market rate, right? Discount rate will always be on the basis of the market rate, right? So that scenario will not arise. So people are saying be limited debit to sale, right? So they are saying trade receivable debit to sale. And what is the amount? Obviously 1 lakh rupees. right? After 2 years, I will get my money back. Bank account debit to trade receivable. Guys, one more thing, in the previous two examples or in the previous three examples, right? We have passed 4 accounting entries. One, day one, second, prepaid rent or prepaid employee benefit expense, and the third is interest income, right? And fourth is refundable. If someone asks you that, sir, you told us yesterday that initial recognition measurement principle, if I talk about measurement principle again, right? For financial asset, we said amortized cost, FET, OCI, and FET PL, right? Initial recognition, fair value, and subsequent recognition, amortized cost, as the name of the category suggests, right? We discussed this principle yesterday, correct? Now, guys, no one has raised this question, sir. In this principle, in the last 2 or 3 questions, we have recognized the security deposit at fair value, which is this one, right? And subsequently, when we have recorded the accounting entries at the end of year 1, at the end of year 2, and at the end of year 3, we have never recognized our security deposit at amortized cost, right? I'm repeating my question again. So on the initial recognition, we said that 1 lakh rupees is to be recognized at fair value. That's why we have recognized this at 75, I think 131, correct? And on subsequent recognition, we need to recognize this security deposit or loan to employee at amortized cost, right? But we have never recognized at amortized cost. Can you answer this question? Ki whether we have recognized this amortized cost or whether we have not recognized on amortized cost the subsequent recognition of security deposit? Yes or no? So people are saying we have recognized security deposit. How we have recognized? What we have said, how to compute the amortized cost? Opening balance, right? So if I'm computing this at the end of year 1, opening balance 75131, right? Plus plus security deposit paid, which is 0, right? Plus any interest which I'm charging, right? I think we have charging 7513 for the first year, right? Minus any payment of security deposit, which is 0, plus or minus any bad debt, which is again 0. So that means the closing balance of security deposit will automatically comes out to be a amortized cost, because we have passed the accounting entry separately. We have passed the accounting entry of this separately. The closing balance will automatically comes out to be a amortized cost. Are you guys with me? Are you guys with me? Yes or no? Very good. Okay. Now let's come back to our trade receivable example. Okay, so we said A limited, B limited, 1 lakh rupees. These will be the accounting entries, right? Now let's evaluate Ind AS, right? Is it a financial instrument? Yes, sir. Is it a financial asset? Yes, sir. Sir, then we need to evaluate what? Amortized cost. Sir, what about business model test to collect? It will get satisfied. Sir, this principal is linked or interest, rate of interest is 0%. Sir, is this linked with the consumer price index? No. Equity share price of any company? No. Or any other index? No. So this will get okay, this will get satisfied, and amortized cost will get satisfied, right? So sir, initial recognition, fair value, subsequent recognition, amortized cost. This is what we have discussed. Now guys, now come to Ind AS accounting entries. First accounting entry, let me write trade receivable debit to sale. Now tell me what should be the amount on day one. Question has got changed, guys. First दो question मैंने same number लिए थे, यहाँ पे number change कर दिए हैं, right? So be careful. What should be the amount of trade receivable? What should be the amount of sales? I will be waiting for your answers. Sumit Gupta is saying, sir, 82,645. कहाँ पे लिखूं सुमित? Whether it's a part of trade receivable or whether should I write 82,000 here? One person is saying सेल तो 1 लाख रुपए की करेंगे. Okay, सेल्स में 1 लाख कर देते हैं. Correct. What about trade receivable? One person is saying trade receivable is 82,645. 82,645. Now difference आ गया around 17,000 का. Right? What is the number? 1 lakh minus 82,645. 7,355. 17,355. Now tell me where should I recognize this 17,000? Where should I recognize this 17,000? Don't tell me prepaid rent. Don't tell me prepaid employee benefit expense. It can be a deferred asset, but we need to define what is the nature of deferred asset. First case, we said in case of security deposit, it is a prepaid nature, prepaid rent. In the employee benefit, we said it is in the nature of prepaid employee benefit expense. If you are saying it is a deferred asset, tell me the nature. Most of the people are saying interest accrued. Interest accrued. My simple question. A Limited deposited in bank 1 lakh rupees at the rate of 10%. Day one accounting entry of investment in FD, right, to bank. बैंक 1 लाख आ गया, FD का इंटरेस्ट 1 लाख आ गया. Should I accrue anything on account of accrued interest? पीरियड तो हुआ ही नहीं है. Accrued interest का कॉन्सेप्ट क्या होता है? When I have completed some period, only then over that period I will recognize interest. Interest accrued is to be recognized after a particular period. And what is interest accrued? Which is not yet received now, but I have accrued the income over the period. Right? So how can you say day one पे तो interest accrued आ जाएगा? Have you completed certain period? No. So how can you recognize interest accrued in this case? One person is saying discounted sale. Discount कर दो इसको. तो अगर डिस्काउंट कर दो तो यानी कि सेल को ही नेट कर दो. सेल नेट हो जाएगी तो 82,465 हो गया, तो मेरा टॉप लाइन रिड्यूस हो गया. राइट. वन पर्सन इज सेइंग इसको डेफर्ड रेवेन्यू कर दो. ओके, डेफर्ड रेवेन्यू कर दिया. उसके बाद नेक्स्ट अकाउंटिंग एंट्री क्या होगी नेक्स्ट ईयर में? If let's say I passed as deferred revenue, what should be the next accounting entry in the next year? तो ये तो अभी डेबिट आ रहा है, राइट? तो नेक्स्ट ईयर में क्या एंट्री होगी? ईयर 2 में और द एंड ऑफ ईयर 1 I will credit this deferred revenue, right? And what should I debit? Debit में क्या करूंगा? डेबिट में ट्रेड रिसीवेबल कर दूंगा. ओके, वन पर्सन इज सेइंग डेबिट में मैं ट्रेड रिसीवेबल कर दूंगा, बट ट्रेड रिसीवेबल तो हम तब करते हैं ना व्हेन वी हैव सोल्ड द गुड्स. In this case, I have not sold the goods at the end of year 1. What is trade receivable? That means I have entered into a trade with the other party due to which amount is recoverable. Have you guys gone through Ind AS 115? Have you guys gone through Ind AS 115? Okay. So people are saying, sir, we have not gone through Ind AS 115. Okay, my first entry is trade receivable to sale or revenue, right? What is the discounted value you guys got? 82, 445, I think, right? Right? So this trade receivable is governed because of Ind AS 109 and this sale is governed because of Ind AS 115. 8 to 645. 8 to 645. Okay. This trade receivable is governed because of Ind AS 109. So I need to recognize this at fair value, right? And this sale is governed by Ind AS 115. And what Ind AS 115 is saying? That the revenue needs to be recognized at the present value of the consideration received or receivable, right? This, what is the definition of revenue? Present value of consideration received or receivable after adjusting discounts, right? So because of the application of Ind AS 115, my sale number will come out to be 82,645. There is no prepaid asset in this case. हर बार prepaid asset नहीं आएगा, my dear friend. So I think people have computed 82,000 basis a 10% discount rate, right? Discount rate 10%. I hope people must have computed on 10%, right? So this sale will be recognized at fair value, right? So if I compare this sale versus Indian GAAP sale amount, guys, यहाँ पे तो 1 लाख रिकॉग्नाइज कर रहे थे, यहाँ पे हम 82,000 रिकॉग्नाइज कर रहे हैं. That means I am reducing my sale value. Now the people will start asking question, sir, what about GST? Sir, what about GST? GST उतना ही लगेगा जितना आप actually cash outflow हो रहा है, right? GST उतना ही लगेगा जितना cash outflow हो रहा है, but you need to maintain a reconciliation with the GST as per the GST books and GST as per the accounting books. That means sale as per the accounting books, sale as per the GST books. That means we need to maintain two books of accounts. Earlier, when we used to have sales tax, we used to have a reconciliation between sales as per sales tax books and sales as per the accounting records. We used to maintain those books. Similarly, the same concept will continue here. And believe me, guys, these are all book value accounting, right? It will not have any impact on income tax, which we have seen in the last couple of questions. It will not have any impact on GST as well. We need to pay GST because the concept of sale is different under GST law and different under Ind AS accounting, right? So this will be my first accounting entry, trade receivable debit to sale, right? This is only a book entry accounting, guys. Try to understand. We are passing all the Ind AS accounting impact is notional. We need to digest the statement. All Ind AS accounting is notional, right? Okay, so when this will be the accounting entry, what is the accounting entry at the end of year 1 and at the end of year 2? What should be my second accounting entry? Now, can any one of you tell me? Right, this needs to be governed as per 115, we have accounted for. This needs to be governed as per 109, day 1 accounting fair value. तो fair value हमने कर दिया. कहाँ है fair value? ये रहा. Subsequent accounting, amortized cost. Now we need to pass the accounting of amortized cost. What is the amortized cost? Treat this as a financial asset, right? So what is the accounting? Receivable to P&L other income, right? What is the amount? Day 1 0, at the end of first year 8265, right? Security deposit में interest income book करी थी. Similar accounting I will pass in this case as well, right? What is the next year amount? Can anyone tell me what is the next year amount? 82,000 plus 8,000 multiplied by 10%. 9091. 9091. Right? They should come out to be 17,000 something. 8265 plus 9091. 17,356. 82645. This should be 905. 17,355. Right? And guys, what is happening? This P&L is not your main revenue stream. This P&L is your other income. So under Indian GAAP, if you compare with the Indian GAAP accounting, we have passed 1 lakh rupees as a main revenue top line. But here the top line has reduced to 82,000 rupees, and this 17,000 has been divided over the period of 2 years. Ultimately, this is what the substance is, right? So 2 साल का credit period कौन देता है? So एक तरीके से I have passed on the loan कि मैं आपको 82,000, मैंने आपको 1 लाख रुपए का लोन दे दिया, राइट? मैंने आपको 82,000 रुपए का नंबर दे दिया, आप उस 82,000 रुपीस पे यू विल पे इंटरेस्ट बैक टू मी, राइट? सो आई bifurcated 1 lakh rupees into two portion. One is the main revenue, one is the interest income. Why interest income? Because it is to be treated as a kind of benefit which I am passing to my customer, right? And this receivable will not be a trade receivable, because मेरा जो trade receivable क्या होता है? Sale of goods. मेन बिजनेस से जो रेवेन्यू आ रहा है और रिसीवेबल आ रहा है, दैट इज ट्रेड रिसीवेबल. दिस इज नॉट माय मेन बिजनेस ऑफ पासिंग द क्रेडिट. My main business is of passing the sales of rendering the services, right? So this is my trade receivable, this is my other recoverable, other receivable, this is my income, main income, this is my other income, right guys? And what will be the third accounting entry? I will get my money back, trade receivable to other receivable, right? What will be the entry? I will get 1 lakh rupees only, right? 17,000 on account of this recoverable, and 82,645, 82,645 on account of main recoverable. And guys, people are asking back to back the same question, sir. It will happen only in case of long term. Yes, I have answered this question. It will happen only in case of long term. Why we are discussing long term? Because the problem arises only in case of long term. If it is a short term in nature, then what will happen? No discounting is required. We need to give a disclosure that my current assets and current liability are approximately representing the fair value. Correct? So this is my trade receivable, this is my other receivable. People are asking, sir, what happened to the inventory? Inventory तो मेरी जो पड़ी थी उतनी वैल्यू पे आउट होगी. Inventory तो मेरी सेम वैल्यू पे आउट होगी. I will reduce my inventory at same value, right? So how my margin will be reflected in my P&L? Inventory में cost पे reverse करूंगा, right? And parallelly I will recognize the sale at a profit margin. So that is why my profit will come, my margin will come in the P&L. So inventory will reduce at cost, right? Because मैं remove कर रहा हूँ inventory को, and my sale is booking at profit. That's why the profit will rise in the P&L. GST discount नहीं होगा, because GST is not a financial asset, right? GST I will pass a separate accounting entry. Okay, Akhilesh is saying, what if the period of recovery is uncertain? So Akhilesh, if let's say you sell me a goods of rupees 1 crore, right? Now tell me, when should I make the payment to you? Can you say it is uncertain? When? जब मेरे माइंड में आएगा, जब मेरा दिल करेगा, then I will make the payment to you. Do you agree on that statement? If let's say you sold a goods of rupees 1 crore to me, right? And it is not certain, then when I will make the payment. If I like in the future, I will make the payment. If I don't like in the future, I will not make the payment. Do you agree with that statement? Akhilesh is saying yes in case of related party. So in case of related party, if it is happening, right? So first of all, that needs to be defined. It needs to be of arm length. Section 188 compliance of the Companies Act, right? It should be in the ordinary course of business. It should be as per the arm's length principle. So if you are not defining your period, is it in the ordinary course of business? राइट, ऑर्डिनरी कोर्स ऑफ बिजनेस मींस जो आप थर्ड पार्टी के साथ कर रहे हो वही सेम ट्रांजैक्शन आप कर रहे हो, राइट? सो यू शुड बी वेरी केयरफुल इफ यू आर डूइंग सच ट्रांजैक्शन, दैट विल बी अ नॉन कंप्लायंस ऑफ सेक्शन 188. People are saying if recovery period is less than 1 year, no need to do discounting. Guys, we have discussed this question multiple times, today's as well, yesterday as well. So people are saying, one person is Hindu is saying how to treat overage trade receivable. That is a overage trade receivable is a different concept. You need to evaluate the provision for doubtful debt. You need to evaluate a provision for doubtful debt in that case, expected credit loss model. Okay. Ranjit is saying if the party pays advance of 20%, that my trade receivable will get reduced. My trade receivable will get reduced. Then what I will do? 20,000 rupees to bank account ही आ गया, right? I will debit bank, right? And differential की discounting होगी. Correct? Okay. Tejal has raised a question, sir. In computation of income tax, other income will be income from other source. Absolutely. Yes. If PO terms is 90 days, but amount not received after 1 year, then how to? If 90 days, no need to do discounting because it is short term in nature, current in nature, and the amount has not been received, then you need to look at provision for doubtful debt. Indu is saying if creating provision is already done, then no other treatment is required as per this Ind AS. Yes, if let's say 1 lakh rupees recoverable, you have created an entire provision, then nothing is required. Two set of accounts is required to be maintained for GST purpose. Absolutely, that is, there is no doubt in that. And I tell you guys, ICE has issued a guidance a couple of years back, and they've said that the sale or revenue amount as per GST books, as per Ind AS books, can be different. It is more likely possible because the value of sale, definition of sale is different under GST. The definition of sale is different under Ind AS. Somebody is saying, do we need to maintain different books of accounts? Absolutely yes. Absolutely yes. So when we are saying different books of account, guys, let's understand what is the meaning of this. जब हम इनकम टैक्स फाइल करते थे तो इनकम टैक्स के लिए भी तो हम सेपरेट बुक्स मेंटेन करते हैं. What is separate books? We prepare income tax computation. That is a separate books, right? Indian GAAP में when we used to prepare Indian GAAP, we have one set of books of Indian GAAP, right? For income tax, we prepared separate books. And what is that separate books? We compute income tax. PBT pick किया and plus minus changes which are supposed to be done as per the Income Tax Act 1961. That is the income tax book. Similarly, we need to create a GST books. और इंडिया से पहले we used to create separate books for sales tax as well. अब सेल्स टैक्स की जगह GST बुक्स है. करेक्ट, GST रिकंसिलेशन, GST बुक्स कह देंगे हम उसको. Sumit is saying, but in case of income tax, there are limited adjustment. Okay, but in GST, there can be more adjustment. In case of sales tax, there can be more adjust. There used to be more adjustments, right? So that needs to be maintained. So I tell you guys what is happening. If you evaluate last 6 years when we have adopted Ind AS in India, initially we said that companies X said or MCA said that guys or the companies, you should move on from Indian GAAP accounting to Ind AS accounting, right? So we have moved on. Then CBDT comes into the picture. CBDT says that MCA has issued 39 accounting standards, so we will issue our accounting standard, right? And they have issued 10 accounting standard. I think section 145 A something section hota hai under income tax, and they have issued 10 accounting ICDS, income tax computation disclosure standard, right? Ind AS में 39 standards हैं, ICDS में 10 standards हैं. That means one-to-one standard have not been issued. First of all, second, what has happened? The ICDS which they have issued are 90% based on the Indian gap books. That means पहले हमने कहा कि Indian gap से Ind AS आ जाओ, हम आ गए. Then CBTT comes into the picture. CBTT says कि भाई income tax payment करने के लिए you have to follow ICDS, and ICDS are based on Indian gap 90%, right? So that means for the preparation of books of accounts, Ind AS follow करो दो. For the preparation of income tax, you need to go back to Indian GAAP accounting, because whatever the accounting adjustment you are passing, which is notional in nature, you are not supposed to pay tax, you are not supposed to allow as a deduction. तो उन सबको हटा दो, तो हम कहाँ पहुंच जाएंगे? वापस इंडियन गैप पे पहुंच जाएंगे. For GST, GST team comes into the picture. They says we need our GST as per our principle. So that means in Indian scenario, there are multiple laws which is going on, and as a chartered accountant, we should be happy that there are multiple challenges available, multiple things are available, so that we keep on getting good work. Okay, Pankaj is saying when the payment are made on a milestone basis, 10% advance, 65% on dispatch, 10% on receipt, 15% after erection, right? So advance जो आ गया उसकी accounting नहीं होगी, जो short term है उसकी discounting नहीं होगी, जो more than 1 year है, you need to do the discounting. Simple. Or you can evaluate जो short term है within which is to be recoverable within 1 year, whether the discounting impact is more or low. That is a materiality judgment which a company needs to apply. So Salim, after a long time, he's saying you are saying that we should debit the party for a discounted amount instead of 1 lakh rupees. Salim, for the last 15 minutes, we are discussing the same thing. Rishikesh is saying CAs are getting business. That is good, but may hamper the ease of doing business. No, this will not hamper the ease of doing business. The passing the accounting entries or recording the accounting entries is a job of an accountant or a chartered accountant, right? It will not impact any business transaction, right? So once the transaction get over, then role of chartered accountant comes into the picture, how to record it. Okay, guys, I think we have enough discussion on this particular topic. Let's move on. This is the question number 4, right? Let's move on. Next question. Okay, guys. Question number 5. Now it's a case of holding and subsidiary, right? Holding company has given a let's say loan to subsidiary of rupees 1 lakh for 3 years, right? Repayable after 3 years. Repayable after 3 years. Correct? quickly tell me Indian GAAP accounting in the books of H Limited and S Limited. Fastly, guys. Okay, Salim is saying if some litigation is going on, how much we can recover, discounted amount or the full amount? It's up to you, your negotiation. Okay, first is I have given a loan, so loan to S to bank, amount 1 lakh rupees, right? S Limited has received a loan, bank account debit to loan from S, 1 lakh rupees, right? Correct. And when this will be refunded, the second entry after 3 years. After 3 years, what should be the accounting entry? Bank debit 1 lakh to loan 1 lakh, right? After 3 years, he will say, I will give loan from H, loan from H to bank, right? So these will be the accounting entries. These will be the accounting entries, and it is a interest-free loan. Interest-free loan. We have seen multiple transactions between holding and subsidiary, guys. Now let's evaluate under Ind AS. H Limited, and then we will evaluate from S Limited. For H Limited, is it a financial instrument? Yes. Is it a financial asset? Yes. Is it a amortized cost? First is business model test to collect. So objective is to collect after 3 years. So this condition will get satisfied. SPPI, principal exists? Yes, sir. Interest exists? Yes, sir. The rate of interest is 0%. Is this principal interest linked to the equity share price? No. Index? No. This condition will get satisfied. Amortized cost. Sir, for the last 4 or 5 questions, you are only talking about amortized cost. What about other FETOCI? What about FETPL? There is no question which we have read. Guys, problem only arise in case of amortized cost. Problem FETOCI और FETPL में तो है ही नहीं. वहां पे तो करना क्या है? We need to get it the fair valuation done from the valuer, and we just need to record an accounting entry. Right? यहाँ पे तो सारी accounting entry, calculation, computation we ourselves have to do. So therefore, the problem only arise in case of amortized cost. Problem never arise in case of FETOCI, FETPL. Right? But we will take one example on FETOCI and FETPL. Okay. So this is amortized cost. Initial recognition, fair value. Subsequent recognition, amortized cost. For S, it is a financial liability. Is it a financial instrument? Yes. Then is it a financial liability? Yes. First, then classification amortized cost as a default category. Then what is the principle? Initial recognition, fair value. Subsequent recognition, amortized cost. Now guys, tell me, am I clear on the evaluation of a transaction from the investor or from the issuer perspective? Yes or no? Just by plotting this diagram or this table, we are recalling everything which we have read since yesterday. Yes or no, guys? Are we clear? At least yes or no. There are more than 140 people. Okay. Okay. Can I rub this so that we can move on, because I need this space? Can you quickly copy it? Done, guys? Yes or no? Okay. Let's keep it for 2 years because we have limited space to pass the accounting entries here. Let's keep it for 2 years. So Ind AS accounting, H limited and S limited, right? So what is the first accounting entry? Loan to S and to bank. And S के केस में क्या है? Bank account debit to loan from H. राइट बैंक तो फेयर वैल्यू पे आएगा. सो बैंक मेरे पास है 1 लाख रुपीज चला गया. सिमिलरली बैंक इसके पास 1 लाख रुपीज पे आ गया. नाउ टेल मी व्हाट शुड बी द अमाउंट आई शुड राइट in case of loan to S. Initial recognition, fair value. This is asset side, right? And this is liability side. What should be the amount I should write in case of loan to S and loan from H? Quickly, guys. This will be at fair value, right? This will also be at fair value. Now tell me, let's say discounting rate is 10%. And we have considered the period of 2 years, guys. Don't compute 3 years basis. So Akhilesh is saying 82645. 82645, right? So there is a delta. What is the amount of delta? Around 17,000. 1 lakh minus 82,645. 17,355, right? Here what should I write in the books of S? What should I write? 82645. Okay. Now there is again a delta 17,355. Now tell me, guys, is it a prepaid asset? Is it a prepaid asset? Is it a prepaid rent? Is it a prepaid employee benefit expense? Is it a deferred asset, or what it is? Ruchir has raised one question. Sir, discounting rate can be different from H&S. We will come to this question later on. Let's complete this part, then I will explain on this part. Vikas is saying other equity. Vikas, what is other equity? If I write other equity, can you read this journal entry? What does it mean? One person is saying dividend. One person is saying deemed interest. Anything else? One person is saying investment. One person is saying capital contribution. What else? Anything I'm leaving? Deferred interest. Okay. What else? Deferred asset. What else? Advance recoverable. सारी बैलेंस शीट की एसेट आइटम गिनवा दो. Right? Okay, guys. Let me explain now. Right? So yesterday what we said that जब हम लेसी relationship पे बात कर रहे थे, then we said we need to evaluate that relationship to identify where is delta goes. In lesser lessee relationship, we says it's a prepaid rent. In an employee-employer relationship, we said it's a prepaid employee benefit because relationship यही है employee का और employer का to pass on the benefit in terms of employee benefit cost. In case of trade receivable, we said there is no benefit because both needs to be recognized at fair value. But here we are saying H Limited and S Limited, these are holding and subsidiary relationship. And what is the accounting terminology to record that relationship is nothing but investment and capital contribution, right? So that means 17,000 को मान लिया जाएगा it is deemed investment made by the holding company into a subsidiary company, and in the books of subsidiary company it is deemed, उसको मान लिया जाएगा it is a deemed capital contribution made by the holding company into a subsidiary company, right? So what should I write? Deemed investment, and this is deemed capital contribution, right? This 17,000 will be treated as deemed investment in the books of holding company, and this in the books of subsidiary company, this will be treated as deemed capital contribution. Now the question arises, sir, where I need to show this deemed investment in the books of holding company? It will form a part of investment, right? With separate disclosure is required. Correct? And this deemed capital contribution needs to be recognized in statement of changes in equity. Any doubt in the first accounting entries? Right? So in this case, guys, let me clarify one more point that you guys have considered 10% while doing the discounting in the books of H company and the same 10% while doing the discounting in the books of S company. Practically, yesterday we discussed when we are doing the discounting of asset side, we will take FD rate, right? And when we are doing the discounting of liability side, we will take incremental borrowing rate. So ideally, holding company should take FD rate, maybe let's say 6%, right? And S company should take incremental borrowing rate, maybe let's say 8%, right? This delta is possible, right? This delta is possible. And how this investment or deemed capital contribution in this scenario will get changed. Holding company will show different number of deemed investment. Subsidiary company will show deemed capital contribution with a different number. It is largely possible. And how this number will get eliminated? This 17,000, when they go for the consolidation, this will get knocked off, right? And if they have used the different discounting rate, when they go for the consolidation, the adjustment of this differential needs to be reversed in a consolidation as a consol adjustment. That means ये अपने 17,000 रिवर्स करेगा, ये अपना कुछ और नंबर रिवर्स करेगा इन द कंसोल, जो डिफरेंशियल होगा that will be reversed in the console through the respective account where the hit has been taken, right? So this is how it practically happens, and practically in the holding and subsidiary relationship, the companies practically does mirror accounting. That means जो rate ये ले रहे हैं वो rate वो ले लेते हैं practically, right? But if I go with the logical accounting, because this concept has not been defined anywhere, this concept has not been defined anywhere, right? But this is a concept we follow principally and practically, right? But in case of holding and subsidiary relationship, to in order to avoid the challenges only from the discounting perspective, they take the mirror, they do the mirror accounting by taking the same discounting rate. Right now, it depends upon the discussion between the company and the auditors where they settle, right? If there is a material impact, the auditor generally don't agree. If there is an insignificant impact, auditor gets agree. Rishikesh is saying discounting rate needs to be disclosed. No, discounting rate is not required to be disclosed, but there are certain disclosure needs to be made as per Ind AS 113. that where you are doing a disclosure, wherever you are doing the discounting accounting, what is the principles you have made, not as per Ind AS 109 but as per Ind AS 113. Right? Rajनीश is saying sir how to account for differential discount rate, इसको आप 6% पे डिस्काउंट करो, इसको आप 8% पे डिस्काउंट करो, ये 17,000 डिफरेंट नंबर होगा, ये 17,000 डिफरेंट नंबर होगा. Right? Now standalone mein it will not make any impact. When they go for consolidation, when the company will prepare the consol accounts, then this number needs to be net off, knocked off. Right? So जो differential होगा then वो कहाँ पड़ा होगा, वो इस loan में पड़ा होगा. Then I need to make an adjustment in the loan as well, in the consol as a consolidation adjustment. Okay, Ruchir is saying in case of balance confirmation, balance will not be confirmed. Absolutely, balance confirm नहीं होगा तो क्या होगा, difference आएगा, उस difference का क्या होगा, auditor will ask for the reconciliation. When the reconciliation will be prepared, then this will come into the picture why there is a difference. Then we will got to know it is because of arising of a different discount rate. Right guys, should we move on? Okay. What should be the second entry? I should record an interest income on this loan, loan debit to interest income for first year and for second year. Can you guys compute what is the interest income for first year and second year? And similarly, I will compute interest expense to loan for first year and second year. What is the amount for the first year? If I take 10%, 8265. 8265. Second year, guys, what is the second year number? Nirav is saying, sir, in this example, interest is in loan is interest free. So Nirav, look at the previous example. सारे के सारे example हमने interest free लिए थे. Even then we have booked the interest. 9090. Right? The total must be coming to 7355. Let's check. 8265 plus 9090. 8265 plus 9090. 7355. Right? Third accounting entry will be I will get my bank to loan of rupees 1 lakh. This will be at the end of second year, right? Loan debit to bank, 1 lakh rupees. One question person has asked, in case the loan is interest bearing, तो क्या होगा? Interest bearing है तो प्रेजेंट वैल्यू चेंज हो जाएगी. प्रेजेंट वैल्यू चेंज होगी तो मेरा डीम्ड इन्वेस्टमेंट का नंबर चेंज हो जाएगा. नथिंग एल्स विल हैपन. Okay, people are saying, sir, can you take an example with a rate other than 0%? Okay, in this example, let's say the company is charging at a rate of 3%, right? Market rate is 10%, but the holding company is charging at a rate of 3%. So what will happen when you compute this present value? You need to factor in this rate of interest 3%. We have done this in the employee benefit expense where we have considered the rate of interest is not zero, is more than zero, right? Okay. So now guys, if I evaluate individually what is happening, I am booking a notional interest income in the standalone book, booking a notional interest expense in the standalone books of the subsidiary company. Individually, there is a notional expense and income. But when they prepare the consolidated financial statement, when they prepare the consolidated financial statement, this interest income will get knocked off with the interest expense, right? This loan, this deemed investment will get knocked off with the this deemed investment, deemed capital contribution in the console, right? And individually, loan debit 82,000, loan credit 17,000 plus this loan 82,000 plus 17,000, 1 lakh rupees, and this loan credit 1 lakh rupees, my account will get over, right? Bank credit 1 lakh rupees, bank debit 1 lakh rupees, my accounting in the books of H Limited will get over from the standalone and console perspective, right? If I look at this accounting, bank debit 1 lakh rupees, bank credit 1 lakh rupees, loan from H Limited 82,000, right? Credit 82,000, credit 17,000, credit and loan get debit 1 lakh rupees. My all numbers will get knocked off in the standalone, except deemed investment and deemed capital contribution will knocked off in console CFS, right? This notional income and this notional expense will get knocked off in console. This is how we need to do the accounting in the consolidation books. Okay, guys, I think people are getting still confused. Sir, in case of 1%, Achilles, there is one question. Sir, if the my interest which I'm charging is lower than the market rate, so still I'm supposed to do this accounting? Absolutely yes. Because I'm doing the fair value accounting. If you compute this 82,000 rupees at 3% discounting rate, is that at fair value? What is fair value? At market rate. That means if you end up that transaction with any third party, this should be at fair value, right? So discount, so since the transaction has been entered at 3%, because it is a holding and company relationship, I will get 3%, I will get 5%, I will get 8%, I will get 0%. That will be used for the purpose of the cash flows, right? And for doing the discounting, I will take 10%. Still there is any confusion in the computation of this 82,000? Where I should take discount rate, where should I take cash flows of 3%? Guys, still there is any doubt in that, in the basic principle of CA final, CA inter? Yes or no? If even a small doubt is there, let me know. I will explain again that how the accounting, how the computation needs to be done in Excel. Okay. One person, Surya has raised, sir, where to group the capital contribution in the balance sheet? Surya, before asking your question, I have already mentioned where this deemed investment to be recognized, where this deemed capital contribution is recognized. I know people keep on asking these questions. That's why I have already provided the answer. Just focus on the board. Ashu is saying, please answer for the deemed investment in the standalone. See what I have written in this box. One person, Ruchir, is saying how deemed investment will square off in the standalone balance sheet. Ruchir, don't you think so? It's a question to yourself in the Indian GAAP accounting. अगर एक होल्डिंग ने सब्सिडरी में इन्वेस्टमेंट करी है, राइट, आई एम टॉकिंग अबाउट इंडियन गैप. इंडियन गैप की जो इन्वेस्टमेंट है कभी नॉक ऑफ होती है स्टैंडअलोन बुक्स में? हैव यू एवर सीन दिस? हैव यू एवर सीन दिस? No. Apply the same principle in Ind AS. Day, yesterday, beginning of the class, apply the same principle, apply the knowledge which you already having, right? Apply the past knowledge. We should be clear with the Indian GAAP accounting, and small thing which we need to read under Ind AS. If you are struggling with the Indian GAAP accounting, Ind AS is absolutely a most difficult part. Pankaj has raised one point. So in standalone FS, deemed investment deemed capital contribution will always be there. Absolutely, Pankaj. Indian गैप में investment करिए holding ने हमेशा investment standalone में तो रहती है. Yes or no, Pankaj? If a company has invested in subsidiary, investment always remains in the standalone. Similarly, this will remain in the standalone. This will form a part of the investment. Separate disclosure is required. Subsidiary की books में share capital still रहती है in the standalone. What I mentioned, this will form a part of the statement of changes in equity. Share capital equity का part है, and this capital contribution statement of changes in equity का part है. Loan square off हो जाएगा, but deemed investment deemed capital contribution will never be knocked off unless and until holding and subsidiary relationship will comes to an end. और वो कब end पे आता है? When holding company will sell the subsidiary to any third party. तब होल्डिंग कंपनी कहेगी मैंने 100 रुपए की इन्वेस्टमेंट करी थी, 20 रुपए का बेनिफिट पास किया था, 120 रुपए की मेरी कॉस्ट है, अब मेरे को 150 में बेचना है, देन 30 रुपीज इज माय प्रॉफिट. ट्राई टू इवैल्यूएट फ्रॉम द अकाउंटिंग पर्सपेक्टिव. होल्डिंग कहेगी मैंने 100 रुपीज एक्चुअल शेयर कैपिटल में डाले थे, 20 रुपीज का बेनिफिट पास ऑन किया था बिकॉज आई हैव प्रोवाइडेड द lower market rate of interest. So that means my cost to the subsidy is 120. Now after 10 years down the line, I'm selling at 150. So my benefit is 30 rupees. Are you guys with me? So Pankaj is saying, okay, fine. So my equity will increase forever. Yes. Not share capital, equity. Equity will increase. Share capital is actually a legal capital, right? And this will form a part of statement of changes in equity. Are you guys with me? Ashu is saying, yes, sir, all doubts are cleared. Very nicely explained. Comment on the deferred tax. Deferred tax में doubt क्यों है, my dear friend? I am not so clear. Deferred tax में why there is a doubt? Whenever we are passing, very simple concept, whenever we are passing any accounting, notional accounting entry in books under Ind AS, we need to create a deferred tax. We need to create a deferred tax. Correct, guys? Can we take last? This is which question? Question number 5. 5 benchmarking question we have discussed. Can I take one more question? I need to explain that example in Excel file. Your screen is not clear. Is that the scenario with everyone? Screen is not visible, guys, because I have explained lots of things on the board. If this is not clear since beginning, everything goes back to the square one. Visible clearly. Okay, guys, let's take one more example, the 6th benchmark question, and that will be from the financial liability side, right? Okay, one Pankaj has raised this question. One more thing, in case of fellow subsidiary, scenario will remain the same. Absolutely, it will remain the same. Okay, guys, let's take one more example, then we will take a break. Now I am going to explain you one example from the financial liability side. I'm going to open one Excel sheet and I'm going to present that Excel sheet. Let me know if this is visible to you. Let me know, guys, if this is visible to you or not. Yes, visible. Eh? Okay, I will increase some size. Okay. Okay, perfect. Right now we are going to discuss the financial liability. Let's say, okay, financial liability का फंडा हमने क्या पढ़ा है? Initial recognition. Let me open another sheet. Okay, financial liability, initial recognition, fair value, amortized cost, subsequent recognition, at subsequent recognition, amortized cost. If it is a case of amortized cost category. right? And if it is FVTPL, then it's a case of fair value, right? This is what we have read. Okay. Okay. Let's say I have taken a loan. I hope this is clearly visible to you as well. Let's say I have taken a loan of rupees 1 lakh. Let's say 10 lakh rupees का लोन ले लिया, ठीक है? I have taken a loan of rupees 10 lakhs, right? This is my year. This is, let's say, for the period of 10 years, right? This is my cash flows. And every year I am making a payment of 12%, repayment of 12%, right? I have taken a loan of rupees 10 lakh and I am making a payment of rupees 1 lakh 20,000 rupees, not 12 lakh, 1 lakh 20,000 rupees every year basis, right? So in a nutshell, what I've done, I have paid 12 lakh rupees. I have taken a loan of rupees 10 lakh and I have paid 12 lakh rupees, right? That means I paid an interest of rupees 2 lakh rupees over the 10 years period, right? Now guys, what we need to do, we need to recognize this loan at amortized cost in my books of accounts, right? How to compute? This is my opening balance, right? This is my payment, which I will make to bank. This is my interest and this is my closing balance. Interest, what is interest? Interest needs to be recognized at effective interest rate methodology, right? So this is effective interest rate, right guys? So on day one, I have taken a loan of rupees 10 lakh. Very simple. I'm building a model. Very simple. On day one, I have taken a loan of rupees 10 lakhs, right? Then I will keep on making the payment. Every year basis, I will keep on making the payment, right? That means I will make the payment of rupees 12 lakh over the period of 10 years. Okay. Then I need to accrue interest here, right? We will compute interest and then I need to compute closing balance. How to compute closing balance? Opening minus principal plus interest is equal to my closing balance, correct? I'm just dragging it till the end of 10 year. I'm just dragging this interest till the end of 10 year. And this is my opening balance. This 8,80,000, which is at the end of 1 year, will become the opening balance for next year. So I'm just dragging it till the end of next year, till the end of 10th year, right? Now what is left in this model? We need to compute interest on effective interest rate, right? So let's compute how to compute effective interest rate. So in case of loan, we need to compute effective interest rate on the basis of IRR. What is IRR? It is that rate at which NPV is zero. The full form of IRR, we all know, internal rate of return. It is that rate at which NPV is zero. It is that rate at which present value of cash inflow and present value of cash outflow are equal, right? So let's compute IRR. So in Excel functionality, there is a formula, there is a functionality to compute IRR is equal to bracket start is equal to IRR bracket start, and I need to select all cash flows, right? So my IRR is 3%, right? So I've reached this IRR 3%. So that means at this rate, we need to compute interest. Opening balance multiply by rate, which is this one. I'm freezing it. So this comes out to be 34,000, right? I'm assuming that every payment is made as at year end, right? That is why opening remains outstanding. And this is the number of interest, right? So this is the model which I've developed, guys. And how to check this model, whether this is working fine or not. So that means after making the payment of interest and after making the payment of principal, the closing balance first of all should come out to be 0. It is touch wood in this example, it is actually coming to 0. Second thing, in this example, we have said that 10 lakh rupees, I have taken a loan of rupees 10 lakh, right? And I have paid 1,20,000 rupees every year for the period of 10 years, right? So that means in a nutshell, I have made a payment of rupees 2 lakh on account of interest, right? So it is actual cash outflow of 2 rupees. Now, whether it is Ind AS, whether it is Indian GAAP, whether it is US GAAP, whether it is IFRS, whether it is Irish GAAP, whether it is Japanese GAAP, whether it is any other GAAP, the amount of interest which needs to be booked in my books of accounts on account of interest, that should be 2 lakh rupees, right? Different formula if we are using, different amount will come, but on totality basis, it has to be 20,000 rupees only, right? So we have computed this rate of amount of interest on the basis of effective interest rate or on the basis of IRR, right? Let's see whether the amount is actually coming out to be 20,000 or not, 2 lakh rupees or not. So if I see that my amount of interest is actually coming to 2 lakh rupees in this case, right? So this is the second check. That means my value or my model is absolutely correct, right? So this model is called effective interest rate model, in which the rate of interest is to be computed based on IRR, right? Now tell me guys one thing, we have read in CA final, what is IRR? IRR, it is that rate at which NPV is 0, right? So if I say this is my cash flows, this is my IRR. So if I compute the present value of this IRR, if I compute the present value at this rate of these cash flows, it should come out to be 0, right? So can we compute? We can compute. Let's compute the present value. What is the formula? Formula is very simple, which we have read in class 11. Amount is equal to principal bracket 1 plus R to the power T, right? So I need to compute P here, right? So this is this is amount divided by 1 plus rate. Rate is IRR. What is the power? This is the sign of power under Excel, and I need to select year. So अगर किसी की power 0, it's mathematic function, mathematic formula. किसी की power 0, the number comes to be 1. So first on day 1, it is actually 10 lakh rupees, right? Let me freeze the rate. And if I extend it to 10 year, what is the amount which I should get? I should get 0 amount, right? That means the present value, what is RR? It is that rate at which NPV is 0, right? It is nothing but a net present value. This is cash outflow. This is cash outflow. And this is cash inflow, right? This is my cash outflow and this is my cash inflow. Right? Let me check whether it is coming to 10 lakh rupees or not. It is IRR is that rate at which NPV is 0, which is coming out to be 0. It is that rate at which the present value of cash inflow is equal to the present value of cash outflow. Are we clear, guys? How the EIR model is to be built up? This is what the EIR model is. This is what the EIR model is. This is the separate calculation for the testing purpose. Are you guys with me? Yes or no? I'm not getting the response. People are saying yes. Okay. Now, guys, we have read one more concept in the yesterday class about the transaction cost, right? Let's say what we said, let's say I've taken a loan from bank of rupees 100, or let's say I've taken a loan from bank of rupees 1 lakh and I've paid 5,000 rupees upfront. सो इंडियन गैप अकाउंटिंग क्या होती है, लोन हम दिखाते हैं 1 लाख रुपए का, और जो 5,000 रुपए दिए हैं वो या तो कई कंपनीज पीएनएल में चार्ज ऑफ कर देती हैं या उसको एसेट में रिकॉग्नाइज करके ओवर द पीरियड ऑफ लोन अमोर्टाइज कर देती हैं, राइट। बट अंडर आईएफआरएस वी सेड दैट अल्टीमेटली व्हाट हैज हैपेंड, 1 लाख रुपए लिए, 5,000 रुपए दे दिए, तो पैसे कितने लिए, 95,000 ही लिए। That means I need to record the loan at a rate of 95,000 itself, right? So that means transaction cost will get netted off from the value of loan, right? Now let's say in this example, I have incurred a transaction cost. I have incurred a transaction cost of, let's say, 10,000 rupees. Now let's see what is changing. I am just pressing the button enter. Let's see what is changing, right? My loan has reduced to 9,90,000 rupees, right? My loan has reduced to 9,90,000 rupees, but my cash outflow is 12 lakh rupees. So that means the amount of interest is 2,10,000 rupees. That means the transaction cost which I have paid under Indian GAAP will be recognized as an operating expense, right? And the transaction cost, if I book under Ind AS or IFRS, that will be recognized as a part of interest expense. This is a gap difference from Indian GAAP accounting to Ind AS accounting, right? What is happening here is I have taken a loan of 9,90,000 rupees and I paid 12 lakh rupees over the period of 10 years. Interest amount is 2,10,000. If you look at my IRR has increased from 3% to 4%, right? And if you look at my interest expense which I'm going to book is nothing but a 2,10,000 rupees, right? Sir, but you said the amount, the this liability needs to be recognized at amortized cost. Guys, just see opening balance, transaction during the year, minus any payment, plus any interest, effective rate of interest. This is what? This is amortized cost, right? All these NPVs and cash inflow, cash outflow will get automatically updated. So NPV is coming out to be 0 at 4% IRR, and outflow is coming out to be 9,90,000 rupees, and present value of cash inflow is 9,90,000 rupees. Are you guys with me on this accounting? Yes or no? Are you guys with me on this accounting? Any doubt? Any doubt, guys? Hope things have been clear. That means we have taken 5 examples on amortized cost from the asset side, and we have taken 1 comprehensive example from the liability side, right? And believe me, guys, these are the very normal scenarios which you find when you go outside and do the practical Ind AS accounting from the financial instrument perspective. I hope you are getting some sort of practical understanding that how we need to do this accounting. Tejal is saying, please explain the difference between Indian GAAP and Ind AS. Tejal, Indian GAAP में तो आप बताओगे, I am not an experienced guy. You guys are a champion. What should we do? What should we do in case of Indian GAAP? If I have taken a loan of rupees 1 lakh and 5,000 rupees as a transaction cost I have paid, that 5,000 rupees will be charged to P&L as an operating expense, right? This is a one set of views which the company follow. Second view under Indian GAAP is this 5,000 has been incurred for the entire period of loan, not for 1 year. So this should be charged over the period of loan. So these are the 2 school of thoughts under Indian GAAP accounting, right? But the accounting implication over the period will remain the same. P&L में जाके वो reserve and surplus में जाएगा. So this is Indian GAAP accounting. Ind AS accounting में हम क्या करते हैं, 1 लाख का लोन लिया, 5,000 वापस कर दिए. So in a nutshell, I have taken a loan of rupees 95,000 rupees. So 95,000 का लोन लिया, वापस कितना करना है, 1,20,000. क्यों? 1 लाख तो लोन लिया था, 20,000 इंटरेस्ट के. So in a nutshell, I have to pay 25,000 rupees as interest. So this 5,000 component of a transaction cost will get included in the component of interest. This is the gap difference. इंडियन गैप में अकाउंट करता तो ऑपरेटिंग एक्सपेंस का पार्ट बनता, इंडेस में अकाउंट फॉर कर रहा हूं तो इंटरेस्ट एक्सपेंस का पार्ट बन रहा है, विच इज अ फाइनेंस कॉस्ट. दिस इज द गैप डिफरेंस. Right, guys? Should we take a break? I'm also tired now. Should we take a break for 15 minutes? Okay, let's come back after 15 minutes. I'm hoping you guys are enjoying the session. Great, great. Let's come back after 15 minutes. Okay, guys, should we restart? Okay. Now we have discussed lots of things, guys. Now we need to move forward and discuss couple of items and couple of concepts of Ind AS 32 as well, right? Yesterday, a couple of people have raised, sir, convertible instrument, redeemable instrument, right? Convertible instrument, which is available at the holder, issuer, multiple things, right? So now we have reached to a very good stage where we have understood the definition, where we have understood the classification, where we have understood the initial recognition and subsequent recognition, which is measurement principle, and we have understood the transaction cost accounting. And after that, we have taken 6 examples on the asset side, 5 examples from the asset side, and 1 example from the liability side, right? So now we can say that we have easily understood having a working knowledge of financial instrument as of now, guys, right? Now we are going to take up couple of concepts which will help us in evaluating a transaction. When we say financial instrument is complex, why we say, right? Because of couple of topics we are not aware of the fact that what is the accounting guidance which are available. So we are going to discuss couple of more concept which is into the depth of financial instrument, right? And in the last, guys, we will also take up Infosys annual report accounting policy, which is mentioned in the Infosys report. And believe me, guys, when we will discuss all these things and when we will discuss Infosys annual report, you will find that we have discussed at length. You will find whatever we have discussed yesterday and what we have discussed in the first part of the today's session and what we are going to in the second session. You will find everything is written in the accounting policies of the company, right? So let's continue with couple of more concepts, right, of Ind AS 32. Okay, Ind AS 32, the heading is equity and liability. Equity and liability presentation, right? That means this entire chapter is devoted what is equity, what is liability, right? Let's focus here. First of all, substance of the transaction, right? Substance of the transaction. We need to evaluate substance of transaction, right? Yesterday we took one example, mandatory redeemable preference share. Mandatory redeemable preference shares, right? We said under Indian GAAP, it is an equity, equity shareholder funds. And we said under Ind AS or under IFRS, it is it is financial liability. It is financial liability because as there is a contractual contractual obligation to pay cash, right? So that means we need to evaluate the substance of the transaction. It is not the case that every time we see preference shares, every time we see any other shares, it is always equity. Substance of the transaction needs to be evaluated, right? Okay. Second, component evaluation. What is component evaluation? That means component of each instrument needs to be evaluated. Component of each instrument needs to be evaluated. I hope the board is clearly visible to you. Okay. For example, discretionary dividend, right? Discretionary dividend is in the nature of equity, right? What is discretionary? No contractual obligation to pay cash or bank. That is what the discretionary. If it is a case of mandatory dividend, if it is a case of mandatory dividend, right, then it is a case of financial liability, right? That means there is a contractual obligation to pay cash or bank, right? C, mandatory redeemable, right? So there is a contractual obligation to pay cash. It is a case of financial liability. Contractual obligation to pay cash or bank, right? Let me rub this side. D, convertible instrument, right? Convertible instrument. Where conversion is in the nature of fixed to fixed, then it is equity. Otherwise, it is financial liability, right? Convertible instrument or early conversion option as well. Early conversion option, right? For example, 10% debenture of rupees 1 lakh. Convertible into equity shares in the ratio 1:1.
तो कैमरा थोड़ा लेफ्ट में मूव क्यों कह रहे हैं?
अच्छा, okay. I hope this is visible. right? 10% debenture of rupees 1 lakh convertible into equity shares in the ratio 1:1. This will satisfy fixed to fixed criteria, and it is and conversion is in the nature of equity, right? We will explain what is fixed to fix. So we have talked about discretionary dividend. We have talked about mandatory dividend. We have talked about mandatory redeemable shares, mandatory redeemable instrument, right? So let me explain. So if there is a discretionary dividend, right? Dividend in the Indian scenario is generally considered to be a discretionary nature. Let me write here is dividend in Indian scenario is considered to be discretionary, right? So if there is a discretionary dividend, right, then it is always in the nature of equity because there is no contractual obligation to pay cash. Discretionary means it's my will whether to pay or not to pay. Dividend in Indian scenario is always considered to be discretionary. Why? Because it is to be approved by the shareholders of the company. It is at the discretion of the shareholders, right? So it is always considered to be discretionary. But let's say there is a scenario where we are saying the dividend payment is mandatory in nature, then it becomes in the nature of financial liability because there is a contractual obligation to pay cash. This is what we are reading. We are evaluating a component of an instrument, right? In a particular instrument, let's say 10% preference share of rupees 1 lakh, there is a dividend of 10%. There is a conversion option, let's say, which is available in the instrument, and there is a preference share which is available of rupees 1 lakh. So we are evaluating each and every component of that instrument, right, guys? Are you with me? What is the meaning of the component? So we are evaluating a different component. So dividend, equity nature, if there is a mandatory dividend, there is a contractual obligation to pay cash, and hence it is in the nature of financial liability. Mandatory redeemable instrument, it can be a debenture, it can be a bond, it can be a preference shares. This is called a financial liability because there is a contractual obligation to pay cash, right? Fourth instrument could be in the nature of convertible instrument, right? Convertible means 10% preference shares to be converted into equity shares, 10% debenture to be convertible into equity shares, 10% bond to be convertible into equity shares, right? Those are convertible instrument, and we generally find in the instrument that conversion option is available to the holder, conversion option is available to the issuer, right? That means whose conversion option needs to be exercised and who is having a conversion option. So we are saying if the conversion is in the nature of fixed to fixed, then it is equity, and otherwise it is a case of financial liability, right? One example which we have mentioned, 10% debenture, 1 lakh rupees convertible into equity shares in the ratio 1:1, right? This is called fixed to fixed. I will also explain to you what is fixed to fixed in detail, right? What is fixed to fixed in detail, right? But for sake of this understanding, if the ratio is given in the question, then it is in the nature of fixed to fixed. This will satisfy fixed to fixed test or criteria, and hence the conversion feature is in the nature of equity, right? So let me rub this on the right side and let me explain and write couple of more things. So this is D. Now I'm going to write point number E. Okay. Conversion option. Convertible instrument. Convertible instrument with redemption option. Right? Convertible instrument with redemption option. That means, for example, convertible debenture, optionally convertible debenture, and the redemption option is available there. Optionally convertible. What could be the example? Optionally convertible. Optionally convertible instrument with redemption option. Right? Then how do we evaluate? Where redemption option is available to holder. I will write here available to holder. Where redemption option is available to the holder, then it is a case of financial liability, as issuer cannot avoid making payment. Right? Second is where redemption option is available to issuer. It is equity, as issuer can avoid making payment. Issuer needs to estimate whether payment to be made or not. If payment to be made, then it is financial liability. Let me know, guys, once you are done so that I can start explaining. Done. People are saying done. Should I start explaining the things? Okay, guys. So we have talked about multiple scenario. One is discretionary dividend. That means I have no contractual obligation to pay cash. Then it is equity, right? Three things we have discussed in equity: residual interest, no contractual obligation, and third one is settlement through own equity shares. So we are going to discuss the third one, but where we are saying there is no obligation to pay cash, it is a financial liability, right? So discretionary dividend, financial liability is not the case, it is equity. Second, mandatory dividend, it is financial liability. Third is convertible. Third is what we said, convertible instrument. Convertible instrument, if fixed to fixed criteria meet, then it is a case of equity. If the fixed to fixed criteria does not meet, then it is a case of equity, then it is a case of liability, right? Fourth, we have talked about mandatory redeemable instrument. It is always a financial liability because there is a contractual obligation to pay cash, right? Answer is embedded in the definition what we have read yesterday. What is equity, what is liability, right? If there is a contractual obligation, it is liability. If it is not, then equity, right? One more thing we have read, fixed to fixed, which we need to discuss in detail, right? Now the fifth scenario would be convertible instrument with redemption option. You must have seen optionally convertible debenture, optionally convertible preference share. Redemption option is available to the holder. Redemption option is available to the issuer. Sir, what should I do? It is a financial liability or equity? Boss, I can't comment on that. I need to evaluate who has the option, whether it is convertible or not. If it is convertible, whether fixed to fixed criteria is meeting or not. Whether it is redeemable. If it is redeemable, holder has the option or not. Or if it is, holder is not having the option, who has the option, issuer or not? Answer keep on changing. Where the redemption option is available to the holder, that means होल्डर के पास ऑप्शन है टू रिडीम कराने का. अगर होल्डर कहेगा इश्यूर को कि बॉस रिडीम कर दो, right, then the issuer has no choice, they have to make the payment. Then if they have to make the payment, it is a contractual obligation. If it is a contractual obligation, it is a financial liability, right? Where the redemption option is available to the issuer के पास redemption option है. That means if I am the issuer, I have the redemption option whether to redeem or not to redeem, right? Then I will make a choice. अगर मैं equity shares दे दूंगा, convert कर दूंगा, so I will be in which better scenario, whether conversion is a better for me, whether redemption is better for me. If I am saying conversion is better and conversion is fixed to fixed criteria is meeting, equity in nature. If conversion is better scenario, fixed to fixed criteria is not meeting, it is a financial liability, right? But I'm saying conversion is not a good option for me. Financial redemption is a good option for me. Then I need to estimate which is a good option. अगर मेरे को redeem ही करना है, then it is a case of financial liability, right? So it's a matter of judgment based on case to case. It's a subjective matter. Right, guys? So that means it is the what we are discussing, the component evaluation, that each component of an instrument needs to be evaluated, whether it's a dividend, whether it's an interest, whether it's conversion option, whether it's a redemption option. Are you guys with me? So this needs to be evaluated on day one. This needs to be evaluated on day one, right? Always in the entire financial instrument, evaluation needs to be done on day one. If let's say on day one I'm saying it's in equity nature, but after 1 year down the line I'm saying no boss, I am not going to redeem, I am going to convert, right? So I will say it's a modification or what. Change in the estimate needs to be accounted prospectively then, right? Okay, guys. Let's discuss one more concept. So this is the second concept, component evaluation, right? Now we are going to discuss third point, settlement through own equity instrument, right? Settlement through own equity instrument. That means सेटलमेंट जो हो रही है वो मेरे अपने ओन शेयर्स में हो रही है. लेट्स से A Limited, B Limited. B Limited is the issuer. Who is the issuer? A Limited has made an investment in debenture of B Limited, right? So A Limited has made an investment of rupees, let's say 1 lakh rupees. A Limited has paid 1 lakh rupees to B. B Limited has issued debenture to A Limited. That means A is the holder. A is the holder. And when we are talking about Ind AS 32, we are talking about in the books of issuer only, right? That means Ind AS 32 is provide the guidance only for in the books of B Limited. So sir, for A Limited, we need to go to Ind AS 109 and this is Ind AS 32. First of all, right? So this will be the case where this investment in debenture, which is convertible. Convertible in what? Convertible in equity shares of B Limited. That means try to correlate with the heading of this example. Settlement through own equity instrument. That means a transaction has been entered in such a way that the settlement will only take place through equity shares of B Limited. That means settlement will be through own equity shares of B Limited. Right? That is what the meaning of this heading. Now in this heading, what is the scenario? Now convertible instrument, what is the scenario? That means it will always be a scenario when we are talking about conversion, because settlement is happening through my own equity instrument. Right guys? So what is the guidance which is available? So standard is saying scenario 1, number of shares to be issued and amount of consideration. And this is the accounting. Hope this is visible. So if the number of shares to be issued is fixed, amount of consideration to be paid is fixed, right? Then it is a case of equity, right? This is called fixed to fixed criteria. जहां पे मेरे को नंबर ऑफ शेयर्स जो देने हैं वो फिक्स्ड है, अमाउंट जो देना है वो भी फिक्स्ड है, तब ये इक्विटी माना जाएगा. अदरवाइज इन ऑल द अदर सिनेरियो इट विल ऑलवेज बी कंसिडर्ड एज liability, right? So what could be the scenario where the number of shares to be issued is fixed but the amount of consideration is not fixed, or I can say it's variable, right? Then it is a case of financial liability. Third, where the number of shares to be issued is variable but the amount of consideration is fixed, then it is a case of equity. Sorry, then it is a case of financial liability. Fourth scenario, where the number of shares to be issued is variable, amount of consideration is also variable, then it is also a case of financial liability. Because why financial liability? Because we are saying some exposure is involved in this accounting, right? It is dependent upon market variable, right? It is not in my control, and therefore it is in the nature of financial liability. It is not in the nature of equity, right? So entire standard, guys, as I said earlier, entire standard is based on the premises what is equity, what is liability. डिस्क्रिशनरी डिविडेंड इक्विटी क्योंकि कॉन्ट्रैक्चुअल ऑब्लिगेशन नहीं है, मैंडेटरी डिविडेंड लायबिलिटी क्योंकि कॉन्ट्रैक्चुअल ऑब्लिगेशन है, मैंडेटरी रिडम्पशन लायबिलिटी बिकॉज देयर इज अ कॉन्ट्रैक्चुअल ऑब्लिगेशन. कन्वर्टेबल इंस्ट्रूमेंट अगर वो फिक्स टू फिक्स्ड है देन इक्विटी, अगर वो फिक्स टू फिक्स मीट नहीं कर रहा दैट मींस इन एनी ऑफ दिस सिनेरियो then it is a case of financial liability, right? So this will be a scenario where the fixed to fixed criteria does not meet. Fixed to fixed does not meet, or fixed to fixed criteria gets failed, right? So in this particular scenario, we have talked about a convertible instrument, right? Convertible instrument, what could be the scenario where the fixed to fixed criteria meet? I have written on the board, right? For example, A Limited has invested in the debenture of B Limited of rupees 1 lakh. Conversion है ये सिर्फ, right? In the ratio of 1:1, right? Amount to be converted, with shares, number of shares. Number of shares are fixed today, right? Amount to be converted, let's say it is only 1 lakh rupees. Accounting, it is equity in nature, right? Let's say in the second scenario, this is first scenario, second scenario, amount to be issued is 1 lakh, right? But number of shares dependent on fair market value on date of conversion. So ये क्या scenario हो गया? That means number of share is variable because market price I don't know today, right? So this is variable, this is fixed. What is this? Financial liability. This is how we need to evaluate, guys, right? हमें हर component evaluate करना है, right? One person has raised, what is name, 51074. He has raised the question, if dividend is mandatory but conversion is fixed, is it financial liability or equity? Again, incorrect question. What we are saying, we need to evaluate component. अगर कंपोनेंट डिविडेंड मैंडेटरी है तो आंसर अभी लिख दिया था वो लायबिलिटी है, और कन्वर्जन अगर फिक्स टू फिक्स क्राइटेरिया मीट कर रहा है तो वो इक्विटी है, right? So we have discussed three concepts under Ind AS 32. One is substance of the transaction, second is component accounting, and the third one is settlement through own equity shares. Let me know if there is any doubt in any of these three topics, right? We need to read two more topics, then we are able to combine all these topics and discuss further. Any doubt in any of these three topics? Any doubt? सिर्फ टॉपिक तक ही सोचो, आगे मत बढ़ो. If any doubt is there in any of these three concepts, then let me know. One person is asking, can you please explain the cases being variable? I have just mentioned the example is written in front of you on the board. What is the variable scenario? I'm not sure, guys, people are focusing on the discussion or not. I know there is a confusion there. People may come up. I have already written on the board when it can be a case of variable. It's written. Both being variable कब होगा? When this amount is to be dependent on fair market value on date of conversion. दोनों variable हो गए. Then it is a case of financial liability. Right? So Ruchir is saying substance over form needs to be taken into consideration for when there is a contractual obligation to pay. Yes, there is a contractual obligation to pay. Okay, guys, let me move forward. Couple of more concepts. Then we are able to evaluate a comprehensive example. Okay, Mukund is asking what is the logic behind the equity classification in case of fixed to fixed, because there is no exposure involved. नंबर ऑफ शेयर्स जो देने हैं वो भी फिक्स्ड है, कितने अमाउंट के देने हैं वो भी फिक्स्ड है, नथिंग इज वेरिएबल, नथिंग इज डिपेंडेंट ऑन समथिंग एल्स. That is why there is no exposure, right? But in any other scenario where the number of shares is fixed or amount of consideration is variable or both, there is some exposure involved. That's why the standard setter has said only in this particular case when fixed to fixed gets satisfied, it is equity, otherwise not. Okay, guys. Now we are going to discuss the fourth concept, puttable financial instrument, right? Puttable financial instrument. What is financial instrument? We all know, right? What is puttable? Let's break the meaning. What is put? Put means to sell. Put means to sell, right? So what is the guidance? Where the holder, has the right to put the instrument back to the issuer, then it is a financial liability and not equity. Very, very big impact. Example, buyback right or buyback obligation on the issuer, right? Let's understand this, what I have written on the board. Where the holder has the right to put the instrument back to the issuer, right? Let's say A Limited has made an investment in B Limited, right? Let's say A Limited has invested in equity shares of B Limited of rupees 1 lakh, right? And B Limited has issued equity shares. So A is the holder, B is the issuer, correct? Now, when they have entered into a contract, they have entered into a SHA, shareholder agreement, right? Now, in this agreement, it is written, what is the terms? A Limited has the right to put the instrument back to B Limited, right? Only single line item has been written. A Limited has the right to put the instrument to the B Limited, correct? What does it mean? Let's say this is for the, okay, there is no need for period, right? Now, in this case, when this small line item has been actually written, it means A Limited has the right to sell this equity investment back to the B Limited. That means B Limited has obligation to buy back shares. That means B Limited has contractual obligation to pay cash. In this particular circumstances, this equity, if I would talk about Indian GAAP accounting, B must have passed bank account debit to equity share capital 1 lakh rupees. But because of the applicability of this small line item in the shareholder agreement, I would say under Ind AS, B should pass bank account debit to financial liability of this 1 lakh rupees. That means it is a case where equity share capital can also become a financial liability under Ind AS and under IFRS just by the applicability of one line item. That means holder has the right to put the instrument back to the issuer. This happens, this is not theoretical concept, this happens practically in the today's world. Every startup company, people are investing in the startup companies, investors are investing in the startup companies, right? In order to safeguard their investment, they mention this clause that whenever they want, they can sell this investment back to the issuer, right? Or they generally mention this clause, IPO clause, right? If the IPO does not happen, then the startup companies or the B Limited in this example will pay 1 lakh rupees, which is principal plus 25% IRR for a particular year basis, right? These are the indication of financial liability. So the equity which we have recognized under Indian GAAP that can possibly becomes a financial liability. That means for those companies where the investor is other than the holding company, it is more likely and it is very much required, the evaluation is very much required whether such kind of clauses are mentioned in the shareholder agreement or not. I have seen people on the ground, they generally left equity, they don't evaluate what is the implication of equity under Ind AS, right? Because they are saying this is legal equity, it cannot be changed, right? But if this clause is applicable, right? If I give you a Standard Chartered investor, a firm of capital, a P investor has invested in a startup companies, they generally mention these type of clauses. All the P investor, all the venture capital fund, they mention these type of clauses to safeguard their investment. And believe me, guys, this is actually the biggest impact of Ind AS, where the legal equity of Indian GAAP can be classified as a financial liability under Ind AS. That is what the meaning of puttable financial instrument, where the holder has a right to put the instrument, that means to sell the instrument back to the issuer. Then it is a case of financial liability and not equity. And not equity. Right, guys? Are we clear on the concept of the puttable financial instrument? Yes or no? Okay, Ashu has raised one point. Crux, equity will be there only if there is a decision related to financial in the hands of issuer. Otherwise, it is a financial liability if the decision is exposed to the market or any other contract. Absolutely correct. Sumit is saying period does change the nature. No, period will not change the nature, right? It is ultimately, it is a, if the holder can exercise his right, B Limited cannot avoid making the payment of cash, right? So B Limited is at the mercy of A, but B Limited cannot control A Limited, right? So I need to record this as a financial liability only, right, guys? This is the crux. That is why a separate standard has been drafted on account of what is equity, what is liability. And believe me, guys, if you are doing the audit of any startups, if you're doing the audit of any company in which other than the holding company is the investor, right? Other than the holding company is the investor, then it is very much required that you evaluate whether there is any buyback obligation exists in the company or not. Okay. Jayashree is raising one question. If the period is fixed and A Limited has not exercised the right, okay. Let's say A Limited has the right to put the instrument back to the issuer only for 5 years, initial 5 years. right? And this 5 years have expired. That means there is no buyback obligation exist in case of B Limited. Then it will be a case of modification of the instrument. Then it will be reclassified from liability to equity. But generally think guys, on the practical ground, can it be possible? अगर एक बंदा कोई पैसे डाल रहा है तो वो कुछ ऐसा लिखेगा कि मैं 2 साल तक 5 साल तक ही आप मेरे पास राइट होगा, अदरवाइज नहीं होगा. Ideally in that scenario, B is at the mercy of A Limited. You must have heard the concept of the angel investor. You must have heard the concept of the P investor, right? B needs fund. So whatever A will say, B has to accept all those rights. How can A will say that I will restrict my rights only for 5 years? Practically, it never happens. Practically never happens, right? But if theoretical discussion, if A Limited has the right of 5 years, then after the expiry of 5 years, this financial liability will be transferred back to equity. Right, guys? So just think, things are not complex. Things are not complex. It's only a matter of understanding how do you take it. If you move step by step, things are easier. This is the only guidance, right? This is one line item which is written in the standard, and this is what the meaning of this one line item, how big impact it could be. Right? Should I move on? Okay, this is the fourth point or fourth concept. Okay, fifth, put option available to NCI. What does it mean? Put option, something complex seems to be. Put option available to NCI. What does it mean? Let's say this is holding company, this is subsidiary company, right? Holding company is holding 80%, not 20%, 80%, right? And 20% will be held by minority shareholders, right? 20% is held by minority shareholder. Now, as per the SHA entered, this minority shareholders, or I can say NCI has right to sell or to put their shareholding to H Limited, right, at the rate of 150 per share, right? So in this example, minority shareholder has the right to put their shareholding to H Limited at the rate 150 rupees per share, right? What does it mean? When they have the right, what is the right? कि minority shareholder holding company को बेच सकते हैं. They have the option, they have the right, whether they exercise it or not to exercise it, but they have the right. Since if they will exercise the right, can H avoid making payment of cash? No. In this scenario, H, there is a contractual obligation. Contractual obligation of what? Contractual obligation to purchase NCI shares. If NCI has the right to sell their shares, then holding company cannot say no. That means there is an obligation which exists. There is an obligation which exists on the holding company. So holding company has to purchase those shares, right? But that obligation needs to be recognized today, right? So what is the guidance which is available? If there is put option available to available to NCI to sell their shares, to sell their shareholding to holding company, then it is a financial liability for holding company, right? What is the journal entry? What is the journal entry on day 1? आज तो अभी खरीदे नहीं है, आज तो ये कॉन्ट्रैक्ट एंटर हुआ है that they have a right to sell, but I have not purchased today, they have not sold today, they will sell in future. What is the entry on day 1? Deemed investment to financial liability, and this will be recognized at fair value. One person is asking there is no why there is not a contingent liability. What is contingent? Contingent means it is not probable, right? अगर वो probable नहीं है, उसके chances 50% और less है, तब वो contingent होता है. यहाँ तो अगर उसने exercise कर लिया, so I can't avoid making payment cash. So this standard is saying it is a case of financial liability recorded. So Ruchir is saying, but evaluation is to be made in the books of issuer company, which is S and not H. Absolutely. So we are evaluating in the books of minority shareholder. So minority shareholder has the right? Consequential accounting has been given in this case. If the other issuer has the right, instead of NCI, I can also mention the issuer has the right? Or the NCI shareholder has the right to put the instrument. Then it is a case of financial liability in the books of holding company. That is what we are saying here. Right? I am evaluating from other party perspective, but accounting is also given from the holding perspective as well. Are we clear, guys? Put option. What is the meaning of put option available to the NCI? Out of 141, 2 people said yes. So one person is asking, what is the nomenclature? Nomenclature is the financial liability category, right? You can mention the obligation to purchase the shares of the company, right? Appropriate disclosure needs to be given in the financial statement. Okay, guys. Now we have discussed lots of things on the what is equity, what is liability. One more concept of equity and liability. One more concept. So Akhilesh is saying share capital remains the same, right? And this notional entries will be shown separately in financial asset and liability. Correct or not? No, not. This is not correct. Who said share capital remain as it is? We are for last half an hour or 1 hour. So we are saying share capital can become a liability. Preference shares can become a liability, right? It depends whether there is a contractual obligation or not. Okay, guys. Now the next topic is compound financial instruments. Compound financial instrument, right? Do we know the meaning of financial instrument? Yes sir, we know the meaning. अब तो चाहे कुछ हो जाए, financial instrument की definition नहीं भूल सकते हम. Is that correct or not? Okay, that's very good. Now guys, tell me what is the meaning or the dictionary meaning of word compound? What is the dictionary meaning of word compound? Anand is saying mixture. What else? Alka is also saying mixture. Alka is reverted for the first time here. Ruchir is saying add-ons. Sumit is saying multiply. So if actually the answer which is given in dictionary is a mixture, right? Mixture of two or more elements. So I remember in the sixth class, when sixth or seventh class, we read first time the word compound, right? And when I read the compound financial instrument, I could not make it anything. right? Then I used to think that what is this? What is a financial instrument? I can understand now. Compound, what is compound? Then I opened the dictionary. What is the literal meaning of dictionary, right? And I was able to correlate with my school life that compound meaning is the mixture of two or more element. Correct? This is what we used to read in our school days. Mixture of two or more element, right? Now let's see. Now I'm going to fit the definition of compound in the definition of financial instrument. Okay. So financial instrument, we have already read. For one party, it is a financial asset. For another party, it can be a financial liability or equity, right? This is for first party and this is for second party, right? This is the definition of financial instrument what we have read yesterday. Now, if I say that instead of or, if I will write and, now read again. Any contract entered between two or more parties which give rise to a financial asset of one entity and financial liability as well as equity of another entity is a compound financial instrument. That means the mixture of two or more elements. Over, right? There is no need to read additionally. Just I have replaced the word and from or. So what is compound? That for second party, it is a financial liability, it is an equity, both. Sir, how it could be possible? It is possible. Let's see. Example, 10% debenture of rupees 1 lakh, right? A Limited has issued, A Limited issued, has issued 10% debenture to B Limited, right? 10% debenture is convertible into 1:1 equity shares after 5 years. Correct? Okay. This is the question. How should we evaluate? What is the response? We have read substance of the transaction. We have read component of the instrument, that we need to evaluate the component. What are the components which is available in this question? First component is interest. First component is interest payment. That means, let's say this is for the period of 5 years, interest is to be paid on every year basis. Let me write this as well. Interest to be paid every year, right? So if interest payment has to be made, is this is a contractual obligation? Yes. So from which perspective we are evaluating? We are evaluating issuer perspective, right? Who is the issuer? B Limited. Interest payment, contractual obligation. If this is a contractual obligation, this becomes financial liability for B Limited. This becomes a financial liability for B Limited. Second, conversion option, right? Up now we need to look whether it is a fixed to fixed or not. If it is fixed to fixed, then it is in the nature of equity. If it is not fixed to fixed, then it is in the nature of equity. Then it is in the nature of financial liability, right? So in this case, it is written 1:1. That means fixed to fixed met. Then it is in the nature of equity, right? That means one component is in the nature of financial liability, another component is in the nature of equity. Can I say this is a classic case of compound financial instrument? Just half an hour ago, one person said, sir, one component is equity. Let's say dividend is discretionary and conversion is on fair market value. What is the case? Now I would request that person if he can evaluate after reading this concept. Yes or no, guys? Financial instrument is not complex. When all these concepts when merged into a single issue, single question, then it will become complex to evaluate. Right, guys? Are we clear with the compound financial instrument? Yes or no? Similarly, you can replace debenture with preference shares. You can replace debenture with bonds. You will get the answer. Now, guys, let's say in this particular scenario, if the conversion is dependent, into equity shares, right? अब ये कैसे निकलेंगे? Based on fair market value on conversion date. Based on fair market value on the conversion date. So that means fixed to fixed criteria does not meet. Then if it is does not meet, then it is not an equity, it is financial liability. When one component is a financial liability, second component is also a financial liability, then what is this? The entire instrument is in the nature of financial liability instrument. Then it is not in the nature of compound financial instrument. Are you guys with me? Are we clear, guys? And sir, if you have told us that this is a financial liability, how to account for? Simple accounting, transaction date, initial recognition, fair value, subsequent. We need to evaluate whether it is amortized cost or FVTPL. Amortized cost is a default category. This becomes in the nature of loan. So this will be accounted as amortized cost. Sir, if there is any transaction cost has been incurred, you need to reduce from the value of loan. You need to reduce from the value of debenture. Sir, do I need to apply EIR method? Yes. Sir, how can I apply? Apply the same way which I have applied in Excel file. Sir, do I need to compute the IRR? Absolutely yes. Sir, that means effective interest rate is a methodology on which interest is to be computed based on IRR. Absolutely. Are you guys with me to understand when it is equity, when it is liability, when it is financial liability, when it is compound financial instrument? Simple formula which we have started, simple diagram, financial instrument. For one party, it is a financial asset, and for another party, it is a financial liability as well as equity, that is compound. Now you should appreciate, guys, that why we have devoted 2 hours yesterday to understand the definition. Entire financial instrument is dependent upon the definition of equity, liability, and financial asset. Just by definition, we are clearing our concept. We are clearing lots of our concepts here just by repeating the definitions. How to disclose the compound financial instrument? Anirudh, I would say this is not a correct question. The question you should ask is, sir, how to account for compound financial instrument? Because I have explained you how to account for financial asset. I have already explained you how to account for financial liability, but I have not explained you how to account for compound financial instrument. Disclosure तो बाद में आएगा, पहले accounting तो सीख ले हम. Yes or no, guys? Are you with me? Okay, let me rub this. Okay, compound financial instrument. Right? First, step 1, compute. So we are talking about issuer perspective. Compute the present value of financial liability first. Compute the present value of the financial liability first. Right? And assign the equity as residual value. And assign the equity as residual value. Right? For example, total proceeds. Total proceeds. This much is the amount minus present value of financial liability. Right? I will assign this balance as equity. Right? Second, step 2. Accounting of transaction cost. Accounting of transaction cost. What is transaction cost? Incremental cost. Right? Allocate transaction cost in the ratio of liability and equity computed above. Right? That means how do we compute? Let's say this is my liability, this is my equity, right? This is the amount. Let's say, let me put the numbers so that we are clear how do we are allocating. Let's say this is 10 lakh rupees. Let's say the present value comes out to be 8 lakh rupees, right? So this will be assigned as 2 lakh rupees, right? So liability is 8 lakh, equity is 2 lakh. That means total is 10 lakh. And let's say transaction cost is how much? Let's say transaction cost is 2 lakh only, right? So what I need to do, I need to allocate this 2 lakh in 8 divided by 10. This 2 lakh multiply by 2 divided by 10. Right? So I will get the net amount minus is equal to, right? So what we are saying is 10 लाख रुपए आए, 2 लाख रुपए ट्रांजैक्शन कॉस्ट के चले गए, तो दैट मींस आए कितने? 8 लाख रुपए, right? Net amount which I have received is 8 lakh rupees, right? So equity में कितना जाएगा और liability में कितना जाएगा? Can you guys compute here? What is the net amount which should come here? Can you guys compute? So transaction cost in first case, this is coming out to be 1,60,000 and this is 40,000, right? So net amount in this case, which will appear 8 lakh minus 1,60,000, 7 lakh and 6,40,000, right? And in this case, 1,60,000. So this amounts to be 8 lakh rupees, right? So that means when I have received from any instrument, which is in the nature of compound financial instrument. What is the accounting entry should I pass? Journal entry, bank debit to financial liability to equity. What is the amount? आया तो मेरे पास 10 लाख रुपए है, लेकिन 2 लाख चला भी गया. So I will account for either 8 lakh or 10 lakh rupees. So you will say बैंक चला भी गया 2 लाख रुपए का, right? Financial liability 6 lakhs 40,000 and 1 lakh 60,000. This will be the accounting entry, right? Or you can net it off these numbers. So Vivek is saying, sir, in your example, 10% debenture valued 1 lakh, which is convertible at the ratio of 1:1 at 5 years. In case can you explain how do we compute the present value? We will explain. Don't worry. We will take one question, right? I am just writing the steps and the basis. How do you compute these numbers? Right, guys? So first step is compute the present value of financial liability, right? Assign the equity as residual value. This is the way. Second is transaction cost. Transaction cost अभी हमने समझा था कल, that if I have received 1 lakh rupees loan and I paid 10,000 rupees, loan value is 90,000, right? So transaction cost जो होती है, that should be adjusted from the loan value. If there is an equity, it should be adjusted from equity, right? Similarly, if I have received 8 lakh, if I have received 10 lakh rupees and I have paid 2 lakh rupees, transaction cost shall be allocated in this ratio, right? In this ratio, right? पहले इक्विटी निकाल ली, लायबिलिटी निकाल ली, उस रेशियो में डिवाइड कर दी, देन उनको नेट कर दिया. दिस इज द फाइनल अकाउंटिंग एंट्री. Now this will be recognized in statement of changes in equity, right? I should write in the full sentence, otherwise people keep on chasing me. Sir, where it should be recognized? Recognized in statement of changes in equity, right? As equity component of compound financial instrument, right? And this liability, this is the liability, right? What will happen? Initial recognition, fair value वो कर दी हमने, ठीक है. ट्रांजैक्शन कॉस्ट एडजस्ट वो कर दी, राइट. सब्सिक्वेंट रिकॉग्निशन, amortized कॉस्ट, करेक्ट. यही हमने सीखा है. amortized कॉस्ट कैसे बनाएंगे? ईयर 0 1 2 3 4 5 और मे बी सो ऑन, राइट. ओपनिंग बैलेंस, पेमेंट, इंटरेस्ट and closing balance. This is how we will compute amortized cost. Computation of amortized cost. This is the way, guys, we need to account for compound financial instrument. Happy to answer your question. Let me know if there is any doubt, any question is there. Any doubt, guys? Happy to answer. Okay, one person is asking, Mr. 510745. He is asking, sir, can you explain how did you bifurcate? Okay, very simple answer. I have financial liability of rupees 8 lakh rupees. I have equity of 2 lakh rupees. And let's say I incurred transaction cost of rupees 2 lakh rupees. Now, can you tell me out of this 2 lakh rupees, how much should I allocate in financial liability and how much I should allocate in case of equity? How should I allocate? What is the ratio? Which ratio? Which ratio should I allocate? Right? 8 is to 2 ratio. That is what I have done. 8 is to 2. I have bifurcated 2 lakh rupees. Okay, Akhilesh has raised a big question. I am still not convinced that without debiting the share capital in case of equity becomes a financial liability. How our equity will get changed as in journal entry you created a new debit deemed investment by crediting a financial liability. Deemed investment by crediting a financial liability, because this entry I raised question that our equity will remain the same. I'm not sure, Akhilesh, what concept you are talking about because I have not mentioned any deemed investment here. What is the concept, for which concept you are talking here? This is in respect of which topic, Akhilesh? In the previous question, previous question in respect of NCI, put option available to the NCI. Okay. So what is that question? In that question, we were saying deemed investment debit to financial liability. Correct. So what is the issue in that? I'm still not convinced that without debiting the share capital in case of equity becomes a financial liability. How our equity will get changed as in the journal entry you credit a new debit deemed investment by credit of financial liability, because this entry I raised question, our equity will remain the same. Let me explain again. I'm not sure what is the question you are asking. Okay. So we are saying put option available to NCI, right? Put option available to NCI, right? So holding company 80%, subsidiary company, and NCI is holding 20%, right? NCI has a right, NCI has the right to put their shareholding to H, correct? From day one. So day one, I will create a financial liability first of all, which is at the fair value, because this is the right which is available to the NCI, right? This is the liability, this is the right which is available to the NCI, correct? So I have to create a financial liability first of all. Now tell me, is there any doubt in this? Why should I create a financial liability? Is there any doubt in this, Akhilesh? No. Now tell me, if I'm creating a journal entry, right, on the credit side, do I need to pass on the debit side as well? Do I need to pass the debit side of this accounting entry? Yes or no? Yes or no, Abhishek? Why entry is required in the books of holding company? Because holding company has a liability to make the payment if this right has been exercised. If this right has been exercised, the holding company is supposed to make the payment. I need to create a financial liability. I need to create a financial liability because on day one itself, holding company has given a right to the other party to purchase the shares or to sell the shares to the holding company. So first of all, there is a contractual obligation is available. Contractual obligation exists on holding company to make the payment, right? So when there is a contractual obligation exists, so I need to create. So whenever there is a contractual obligation exists, I need to create a financial liability, right? And consequently I need to create a deemed investment. मैं उसको मान लूंगा कि ये मेरी एक deemed investment है for which I have created a liability, right? This is not a actual investment which I have paid today. This is a future investment for which I booked the liability, and this is in respect of the option or right which I have passed on to the NCI on day one. So I am doing the accounting of the right which is available to the NCI. Correct? And when I will make the payment, in the future, then I will do financial liability debit to bank, right? So let's say this is 100 rupees amount. So ultimately I have reached to the same accounting entry, investment debit to bank 100 rupees, but I have preponed my accounting because the guidance is based on the concept that other party has the right. So I need to book an obligation for that, right? So Ashu is saying if NCI exercise that right, then why S Limited is not making the payment instead of H Limited? Because this is a shareholder transaction. Try to understand, guys. इसकी बुक्स में तो कुछ नहीं हो रहा. He will change only the shareholder. पहले H आ रहा था, NR पहले let's say this is C Limited. पहले H आ रहा था, फिर C आ रहा था, अब H हो जाएगा. So what is changing in the books of S Limited? Nothing. It's a transaction between the shareholders, and the transaction between the shareholder is an equity transaction, right? It is nothing to do with the books of S Limited. S Limited books में तो holder है, holding company का नाम ही तो change हो रहा है. Whether any money is coming in S Limited, no. Whether any money is going outside in the books of S Limited, no. What is changing? This is a transaction between the shareholders. Am I clear to you? Am I clear to you guys? Yes or no? Okay, let me project my screen for one example on the compound financial instrument. Let me search first. Just give me a moment. It's a lengthy question. Just give me a moment, guys. Okay, let me project my screen. People are saying in PPT page number 18. Okay. Let me project my screen. Okay, I hope this is visible to you. So in this case, Company J, let me open the pointer as well. Company J issues 2000 convertible bonds. The bonds have 3-year terms and are issued at par with a face value of 1000 per bond, giving a total proceed of 2 lakh rupees. Let me write on the board. Okay, J Limited issues. So J Limited is the issuer, first of all, right? So J Limited issues 2000 convertible bonds. Okay, convertible bonds. Okay, J Limited has a term of 3 years and are issued at par with a face value of 1000 per bond, giving a total proceed. It is for the period of 3 years, right? Amount received 2000 debenture or bonds multiplied by 1000 rupees per bond or per debenture per bonds. That means he has received 20 lakh rupees. Okay. Interest is payable annually. So what is the interest rate? Interest rate is 6% per annum, right? 6% of rupees 20 lakhs, which comes out to be 1,20,000 rupees per annum. This is payable every year, right? Conversion option is available to the holder. Conversion option is available to holder. Holder has conversion option, right? Each bond is convertible at any time up to the maturity of ordinary shares. So conversion ratio is fixed 1 is to 250. What is the ratio? 1 is to 250. When bond are issued, the prevailing market rate of interest, that means it is the discounting factor. Discounting factor is 9% per annum. Transaction cost is equal to 1 lakh rupees, right? So conversion option is available. Conversion option is available to the holder, right? And it is not mentioned in this question, right? I think something is missing in the respect of the redemption, right? Redemption, who is having the redemption option, right? So let's say redemption option is available to the holder itself, right? Redemption option is available to the holder itself, right? Now let's evaluate, guys. There are multiple, this is a comprehensive question. There are multiple options which is given. First is interest, right? 1,20,000 rupees is mentioned here, and this is to be payable annually, and this is in the nature of financial liability because there is a contractual obligation exists, right? Second is principal redemption, principal payable, principal payment. So you guys can add one line item. Redemption option is available to the holder. I think that is missing here, right? So redemption option, it is available to the holder, then it becomes a financial liability component as well. Third component here is conversion. Conversion into equity shares. And in this case, they have mentioned the ratio. If the ratio has been mentioned that the number of shares to be issued is fixed, right? So it is in the nature of equity. The entire instrument, one component is the liability, another component is equity. This has become compound financial instrument. This has become compound financial instrument. So how to account for compound financial instrument accounting? First, I need to compute the present value of the interest and principal, right? जो भी वैल्यू आएगी 20 लाख रुपए टोटल आए हैं minus the total value which I have received. That means what I need to done, total proceeds 20 lakh rupees minus present value of financial liability. Residual will be assigned as equity. And if there is any transaction cost, which is 1 lakh rupees, it will be allocated in the ratio of liability and equity, right? Let's see what we have mentioned here. So here we have computed the present value of cash flows. So interest 1,20,000, second year interest and third year interest. And third year 20 lakh rupees is the principal repayment, right? So we have assumed that the principal amount is to be paid and it is at option at the holder, not at the option of the issuer. अगर ये issuer का option होता तो क्या होता? Then I will say it is not a liability, it becomes equity. तब मैं इतना ही माइनस करता, most of the portion of 20 lakh rupees will go into the equity portion, right? So in this case, we have treated this as a liability. So interest and principal is this one. I have discounted at 9%. So we have got 18 lakh 48,000. So this amount has comes out to be 18 lakh 48,000 something, right? And equity is 1 lakh 51,878. Now this 1 lakh rupees needs to be allocated in this ratio, right? So second step is allocation of transaction cost between the equity and the liability, right? So उस ratio में I have divided what is the net equity and what is net liability. So ultimately I have received 20 lakh rupees and I have paid 1 lakh rupees. So net में कितने आए? 19 lakh rupees. So I will account for 19 lakh rupees. What is equity in that 90 lakh rupees? What is liability in that 19 lakh rupees, right? And now my financial liability has reaches to 17 lakh 55,000 and I need to repay this entire amount 21 lakh 20,000, 1 lakh 20,000, 1 lakh 20,000 rupees. So I need to build effective interest rate, opening balance, interest, cash paid, closing balance, right? And this is how that we need to compute the compound financial instrument accounting. Are we guys clear? Are we guys clear? I have embedded this compound financial instrument accounting in the Excel file as well. Guys, are you with me? Yes, no, where are we? Are we lost somewhere? Are we in sync? Ashu is saying, how can be conversion and redemption option different? Possible. Possible. This is accounting. Everything is possible in accounting. Doubt, guys, happy to answer your doubt. I'm requesting those guys who were asking the question, sir, what will happen in optionally convertible debenture? What will happen in optionally convertible redeemable preference shares? I am requesting those guys to put up their questions now, because we have reached at those stage that we have discussed what is equity, what is liability. Okay, Ashu is saying what it means if conversion option is with holder, but redemption option is with issuer. So conversion option will not make any impact. What will make an impact is the redemption option, because in case of conversion, we just need to see whether it is fixed to fixed or not to fixed, right? So conversion option will not make any change, but redemption definitely yes. Rocher, in this case, since conversion option is given to holder, now it is accounted for as equity. Conversion option, I said, will not make any change. For conversion option, we just need to evaluate whether the conversion is fixed to fixed or not, right? That will make the impact. For redemption, we said if it is available to the holder, then it is a financial liability. If it is available to the issuer, then it is a equity. Happy to answer your doubts, guys. I'm looking for those people who were asking yesterday. Share warrant. One person is asking share warrant, right? First of all, share warrant. If share warrant is in the nature of equity, right, then it is an equity. If the share warrant is in the nature of liability, that means if there is an obligation that in respect of share warrant you will pay cash, then it is a case of financial liability. Ashu is saying I'm not getting how the conversion and redemption are different components. Both are different. Both are different. My dear friend, both are different. We need to evaluate at the time of evaluation of the instrument. Try to understand. In order to evaluate an instrument, we need to evaluate each and every component. Tomorrow you may say how the interest or dividend is different from the principal, right? Each and every component of an instrument needs to be evaluated separately, and the separate guidance have been shared in the standard which I have shared with you. Vivek is saying buyback clause in the terms represent redemption. Absolutely. Represent the redemption. That's why it's a financial liability. Tejal is saying if share warrant in the financial liability, then to value at amortized cost. See, it depends. It depends. If let's say what is share warrant, what are the different terms, right? Whether it is linked to the equity price or not, right? Whether it is in the nature of derivative or not. Because if you remember in the financial liability classification, we said derivative needs to be accounted at FVTPL category, right? If the share warrant price price to be paid is dependent on equity share price of the company, then it becomes in the nature of derivative, then it will be accounted as a FVTPL category. Otherwise, or otherwise we can look for amortized cost as well, but largely it depends upon what are the terms which is stated in that share warrant. Okay, one person is saying is interest, dividend and repayment or conversion only a major component? Yes, yes, these are the major components. Interest, dividend, repayment, conversion, these are the major component. What else? Question, guys. There are 137 people as of now. At least one should ask one question. I'm happy to answer. But strange, today no one is asking, sir, what will happen in case of convertible instrument, optionally convertible redeemable instrument? Strange, no one is asking. So one person is saying, sir, our concept of FVTPL, FVTOs have missed. Don't worry, I will take one example on that as well. But I'm just looking for the complex item which the people who were asking yesterday, they are not asking today. That seemed to be a surprise for me. Okay, Ashu has raised one big question. If the conversion is in the nature of variable and redemption option is available with the holder, then it is a financial liability, correct? I don't know. Let's evaluate. I don't know. Right? So you are saying conversion option is variable, right? So conversion fixed to fixed fail, right? So it is in the nature of financial liability. What is the second point? And redemption option is available to holder. If it is available to holder, it is also financial liability. What else you have mentioned? Then it is a case of financial liability, correct? Then the difference between present value of cash inflow and outflow, now where it will get debited, then the entire instrument will get financial liability. Then the entire instrument will get financial liability, right? So my entry will be simple in that case, bank account debit to financial liability 1 lakh rupees. Now you have to do the same accounting which we have discussed. Financial liability के accounting borrowing हो गई एक तो. This is nothing but a borrowing. Do the accounting in as in case of loan. Benchmark question number 5 or 7. I am not sure, but do the accounting of loan. Correct, guys. Do the accounting of loan. If it is a holding and subsidiary transaction, तो ये deemed capital contribution चला जाएगा. If it is a transaction with a third party, तो ये अपने आप में ही fair value पर है. Are we clear, Ashu? Right? Now see, guys, how the twist is happening. We have discussed financial asset, financial liability, right? One person is saying, sir, अगर ये scenario होगा तो कैसे accounting होगी? Debit कहाँ जाएगा? ये तो वही transaction है जो morning में हमने discuss करी थी. Correct? That's why I said it's a benchmark question. right? We need to do the accounting. We need to give the reference of those 5 or 7 question. इसको security deposit treat करना है, इसको prepaid employee to loan करना है, इसको debtor discounting करना है, इसको holding subsidiary करना है, and so on. Okay, one person is asking, what will happen if there is a 0% compulsory convertible debenture? Convertible at variable price. Okay, let me write compulsory convertible debenture. So CCD, 0% CCD, right? Convertible at variable price. So it is convertible first of all, right? Let's say A Limited, let me put the entire case study. A Limited issued 0% convertible debenture of rupees 1 lakh to B Limited, right? A is the issuer, right? And this is to be convertible on fair market value after 5 years, right? Convertible after 5 years. So first of all, how many components are there in this transaction? First is interest, which is 0%. Khatam. Second is conversion. Fixed to fixed does not meet because it is dependent on the fair market value. This becomes financial liability. Entire instrument becomes financial liability. Is this the answer to your question, Mukund? One person is saying, please share the board screen. Board, so it's visible. Guys, is my board visible to you or not? So Anil is saying, please share board screen. I'm not sure. It is coming in small. Strange. I have not done anything different. So one person is asking, sir, can we have a break? Rishikesh is asking, Rishikesh, we have only half an hour left and we have lots to do. A couple of more concepts to be explained. Should I move ahead? Okay. Okay, guys, my question to you. We have discussed the compound financial instrument accounting, right? Let's say investment has been made in the CCD, investment has been made in the preference shares, investment has been made in the optionally convertible preference shares, and so on, right? It's a compound financial instrument we have discussed. Now, can you guys tell me how to account for that investment, that convertible preference shares or redeemable preference shares or optionally convertible preference shares in the books of holding company or in the books of the holder? No one has raised this point that sir accounting तो अभी हमने जो करी that is from the issuer perspective, but what about the investor perspective? Now can you guys tell me what is the accounting in the books of holder? Let's say A Limited invested in compulsory convertible debenture of B Limited. B Limited is the issuer, correct? And this compulsory convertible debenture, let's say 10%, interest is 10%, which is financial liability. Conversion, fixed to fixed, meet, right? This becomes equity and this becomes compound financial instrument for B Limited perspective, right? So we know how to account for compound financial instrument. Now guys, my question to you, now tell me how to account for in the books of A Limited in respect of that instrument. How should I record investment in 10% CCD in the books of holding this investor? One person is saying, sir, it is a financial asset. That we already know. It is a financial instrument. It is a financial asset. What else? What else? One person is saying, sir, we need to check amortized cost. We need to check SP, we need to check FET, OCI. We need to check FVTPL, right? Okay, guys. So amortized cost, there are two conditions. One condition is business model test and the second condition is SPPI. In this case, business model test to collect and sell. SPPI is also there, right? SPPI is common. Let's evaluate SPPI in this case, right? In this case, we are saying this is a compound financial instrument for the issuer. This CCT is going to be converted. That means in this instrument, one component is a liability in nature, one component is a equity in nature, right? So what we are saying in case of SPPI, fourth component, principal and interest, whether it is linked to the equity price, yes. Whether it is linked to the equity price of B Limited, yes, it will get fail. If this will get fail, this will also get fail. That means SPPI get fail. I cannot account for it amortized cost. I cannot account for FVTOCI. What is the last resort available? FVTPL. So that means in case of compound financial instrument, ईश्वर की बुक्स में तो हम split accounting करेंगे. This is called split accounting, right? And in the books of holder, we will do FVTPL accounting. Ashu is saying how it will get failed because there is an equity component in the instrument. Because when we have evaluated, interest is a liability nature, conversion option is in the nature of equity. So that's why it get fail. That's why it will get fail and SPPI get fail. It is not amortized cost. It is not FVTOCI. It is FVTPL on each reporting date. Right? ये तो हमने कल ही पढ़ा था. What is the meaning of FVTPL? Every time we will do fair value. That means fair value on each reporting date. Right? SPPI people are struggling to understand how it will fail SPPI. Fourth condition evaluate karo guys. I have talked on twice on this particular aspect. Fourth condition will get failed because it will get linked to the equity price of the P Limited. Because in this instrument there is an equity component which is coming in. Right? So it will get fail. That means compound financial instrument में holder की books में every time it will be a case of FVTPL. Correct, guys? Are we clear with this basic concept? Right? Should we move on? Okay. Okay, guys, let's take a couple of more topics. Derivatives. Can you guys give me an example of derivatives? What can be the example of derivatives? So in case of fair value, one person is asking what will be the fair value. So guys, in that kind of scenario, we ask the company to get the fair valuation done from the valuer. It's not that simple. Right, Ashu? So in that case, we generally ask the companies to get the fair valuation done from the outside, from the independent valuer. Okay, examples. Forward contract. Forward. Options contract. Swap. Principal only swap. Right? Cross currency swap. What else? Future contracts. Right? So these are the difference. These are the difference. Different items of the examples of derivative. Ashu is saying, sir, where the difference will get debited then? Ashu, I'm not clear with your question. Where is the difference coming from? Fair valuation kraya, do the FVTPL accounting. Where is the difference? Okay, guys, focus. When A Limited invest B Limited, right? Day one transaction price will be the fair value, right? Right. So investment in CCD to bank, right? Investment CCD, let's say 1 lakh rupees. Is there any difference in the accounting entry? No. This is day one accounting, right? This is at fair value. Subsequent accounting at the end of year one, P&L debit to investment, right? If there is a dip in the fair valuation, let's say 20,000 rupees, or if there is a gain, investment debit to P&L, let's say 10,000 rupees or 20,000 rupees. So where is the difference, Ashu? I am unable to understand. Where is the difference? Okay. Okay. So derivative. Okay, guys. So this is the derivative. Now tell me, what is the accounting of derivative under Indian GAAP? What is the accounting of derivative on in Indian GAAP accounting? Quickly, guys. You guys have to tell me Indian GAAP accounting. Then I will be tell you India's accounting. Accounting entries of derivatives, guys. One person is saying contingent liability. Very good. Contingent मतलब हम record ही नहीं करेंगे. We just disclose it. Strange. One person is saying, Rubir is saying account exchange difference is MTM and divided to P&L. Okay, let me write. First of all, which standard provides me the guidance? कौन सा standard बोल रहा है to do the accounting of derivative? Okay, so there are multiple things. AS 11, AS 30, 31, 32, right? So first of all, this have been withdrawn. AS 11 only provides the guidance. Para number 36. Para 36 of AS 11 provides the guidance only on the forward contracts, right? So you guys told me forward भी होता है, option भी होता है, swap भी होता है, principal only swap भी होता है, futures भी होता है. But this is only provide the guidance on forward contracts, right? Then we have notification issued by ICI in, if I'm not wrong, in 2008. And then guidance note on derivatives, right? This has been issued in 2015 and is applicable from 1st April 2016, right? So these are the different guidance which is available under Indian GAAP, right? So first of all, this has gone, right? This is only applicable to the forward contracts. In case of notification issued by ICI in 2008, it says book MTM loss and not book, do not book MTM gain, right? And this is saying book loss or gain at fair value, right? And this guidance note same as that of Ind AS guidance, right? So this is the guidance, but what is the guidance? This is the, but what is the guidance? Guidance is Ind AS or IFRS, book gain or loss on derivatives at fair value through P&L. If you remember, for asset side, it is FVTPL. For financial liability side, it is again FVTPL. Journal entry, what is the journal entry? In case of gain, then the entry will be P&L debit, sorry, P&L credit, derivative asset. In case of loss, P&L debit to derivative liability. This will be the accounting entries of derivatives. Right, guys? And this fair valuation, we need to get it done. This will be at fair value. This will be at fair value. We need to get this done from the independent valuer. Right? So this is what the accounting for derivatives. Right? Let me devote 5 minutes on how to do the journal accounting entries in case of investment in OCI. Let's say A Limited, we are talking about FVT OCI. A Limited has invested in bonds of B Limited, right? Let's say this is 1st January 2021. This is 31st March 2021, right? Bonds investment. A Limited invested in bonds of rupees 100 and the value has reaches to 150, right? So what is the accounting entry on 1st January 2021? Investment in bond to bank, 100 rupees, right? 31st March 2020. What should I do? Value has increased by 50 rupees, right? So my investment in bond will be 50 rupees to OCI gain of rupees 50. Right? Now let's say 30th June 2021, I have sold this bond at 180, right? That means the fair valuation has reaches to 180. So what should I do? 30th June 2020. First, I will do the fair valuation of these bonds. Investment in bond, debit 30 rupees to OCI gain 30 rupees, right? And if you remember, this investment in bond is a debt instrument. This will be classified in a category item which is to be reclassified to P&L. So this notional gain will be transferred to P&L in order to actually compute the P&L 80 rupees. अल्टीमेटली मेरे पीएनएल में कितना जाना चाहिए? 80 रुपीज ही जाना चाहिए. 100 रुपए में परचेज किया था, 180 में बेच दिया, 80 rupees in the profit. Just see whether my P&L is getting credited by 80 rupees or not. This is the way we need to do the accounting in case of FVT OCI and this is the way we need to pass the accounting entry in case of FVTPL, but वह ट्रांसफर OCI के थ्रू नहीं होगा, वहां पे डायरेक्ट आएगा P&L में. Guys, are we clear on derivative accounting? Are we clear with the FVT OCI accounting? Yes or no? Hope people are attending the session. Okay. Ashu saying in case of any interest is received, then we will pass through P&L or OCI. Ashu, I have already answered this question yesterday. If you open your coaching notes, we have discussed the debt instrument accounting. We have discussed the equity instrument accounting. In that case, we have mentioned, okay, Anand has reverted. Sir, it will be charged to P&L. It will be recognized in P&L. This is the answer to your question, Ashu. Right? Open your coaching notes. You must see that interest will be recognized in P&L. Dividend is also recognized in P&L. Why? There is a logic, that is the actual gain and loss. Change in the fair valuation is the notional gain and loss. That is why we will park in OCI. Okay, Vivek is asking, sir, ये अगर 100 की जगह 80 हो जाए, रिवर्स कर दो अकाउंटिंग 20 रुपीज से, OCI डेबिट टू इन्वेस्टमेंट 20 रुपीज. Is that clear, Vivek? Okay, guys. Now, can we discuss the Infosys, whether what we have discussed since yesterday, what we have discussed yesterday, what we have discussed today, can we see whether the guidance which is mentioned in the annual report of Infosys, whether we are on the right track or whether we have read something different? Can we discuss the Infosys report, guys, for 10 minutes? It's very important to gain some practical insights. And I am hoping that you guys have gone through Infosys annual report. So people are saying, yes, sir, we have gone. Let me project my screen first. Okay, guys. So this is Infosys annual report, right? So I am on the page number 180 of the PDF file, right? 180 page of the annual report, right? And this is the standalone accounting policy of the company, right? This is the standalone accounting policy of the company. So let's see, we will read only on the financial instrument, right? Okay. Initial recognition. So they have started with the initial recognition. They have said the company recognizes the financial asset and financial liability when it becomes the party to the instrument. So there is a contract. When they have entered into the contract, only then they will account for. All the financial assets and liabilities are recognized at fair value on the initial recognition. What we have read in the initial recognition, that all the assets, all the liability, irrespective of the category, everything needs to be recognized at fair value. So they are mentioning in their accounting policy, all the financial asset and liability are recognized at fair value on the initial recognition, except trade receivable, which are initially measured at the transaction price. And what is transaction price? We said it's at fair value, right? Okay, then they are saying transaction cost. What is the transaction cost accounting? What is transaction cost? Incremental cost. अगर वो transaction ही नहीं होती तो transaction cost भी incur नहीं होती. That is the transaction cost, incremental cost. और हमने क्या बोला? Transaction cost will be adjusted from the loan value, और transaction cost asset side में है. So if it is amortized cost, we will capitalize. If it is FVTOCI, we will capitalize. If it is FVTPL, we will charge up to P&L. Right? We are repeating our concept as well, guys. Transaction costs that are directly attributable to the acquisition or issue of the financial asset and liabilities which are not at fair value through P&L. That means जो P&L से नहीं गई हैं उनको हमने क्या किया? We have added to the fair valuation on initial recognition, right? Regular way purchase and sale of financial asset are accounting at the trade date. मतलब जिस दिन हमने transaction करी उस दिन हम account for कर रहे हैं. Okay. So this is the initial recognition. Come to the subsequent recognition, right? So they are saying non-derivative financial instrument, right? Derivative क्या होता है? We will deal under FVTPL. So now the subsequent measurement. So they have given the three classification of the financial asset: amortized cost. Then they have mentioned fair value through OCI. Very good. Then they have also mentioned fair value through P&L. So that means what we have read in respect of the financial asset category, that seems to be correct, right? Okay. So what is amortized cost? If business model test to collect will get satisfied and SPPI gets satisfied, then it is a case of amortized cost. Let's see what they have written. A financial asset is subsequently measured at amortized cost if it is held within a business model whose objective to hold the asset in order to collect the contractual cash flow. That means they mention the first condition here. If there is a uh, business model to collect the contractual cash flow, then it is a case of financial asset at amortized cost. And second condition, and the contractual terms of the financial asset give rise to the specified dates to cash flow that are solely for the payment of principal and interest. Have we discussed this, guys? SPPI test solely for the payment of principal and interest. When these two conditions get satisfied, then I will classify my financial asset at amortized cost. This is what is written in the Infosys annual report. Okay, move ahead. Then is fair value through OCI. A financial, what is the condition which we have read? Business model test to collect and sell, and the second condition is SPPI. Let's see. A financial asset is subsequently measured at fair value through OCI if it is held whose business model is achieved both. What is both? Both for collecting the contractual cash flow and selling the financial asset. Business model test to collect and sell. And the second condition is which will give rise to the solely for the payment of principal and interest. Then we have talked about irrevocable exemption. Irrevocable exemption is only given in case of equity. Let's read. The company has made an irrevocable election of its investment, which is classified as equity instrument, to present the subsequent changes through other comprehensive income. I hope, guys, you are getting some sort of confidence that what we have read yesterday, what we have read today, that is first of all is correct, and we are getting the same guidance under Infosys annual report. Financial asset which is not classified in the above category is classified as FVTPL. Remember, we said it is a residual category, no condition attached. If the asset is not classified at amortized cost, if the asset is not classified at FVTOCI, the straight answer is FVTPL. Right, guys? Let's move on. Financial liability. What we said in financial liability, amortized cost and FVTPL, no condition attached. If amortized cost is a default category. Let's see. Financial liability are subsequently carried at amortized cost using effective interest rate methodology, except for the contingent consideration in the balance in the business combination, which is subsequently measured at FVTPL. So they must be having a contingent consideration which is arising because of Ind AS 103, and they are recognizing that as per FVTPL. For trade and other payable maturing within 1 year from the balance sheet date, the carrying amount approximately represents the short-term maturity. Most of the people are asking me, sir, if it is beyond, if it is less than 1 year, should I do the discounting? They have mentioned that if it is within a period of 1 year, no need to do discounting. The value, the carrying value represents the fair value approximately. Right? Investment in subsidiary, they mention a separate category. They have recognized it at cost. If you remember, we said that there are two options available under Ind AS 27, that investment in subsidiaries, equity investment either at cost or fair value as per 109. If you opt for cost, apply cost concept of Ind AS 27, which is purchase price plus directly attributable cost. If you're doing the Ind AS 109 accounting, then what is the methodology available? Do the fair valuation, FVTOCI or FVTPL, depend whether it is held for trading or not. Right? Come to the derivative instrument. Derivative instrument. The company holds the derivative instruments such as foreign exchange forward contract, option contracts. We have discussed this, that the counterparty of these contracts is generally a bank, right? And they have accounted at financial asset or financial liability at fair value. Right? So they have recognized this derivative at fair value. So they mention further, although the company believes that these derivatives constitute a hedge from the economic perspective, they may not qualify for the hedge accounting financial instrument. Any derivative that is not designated as a hedge and is not effective 109 is categorized through a financial asset at FVTPL. So there is also a concept of the hedge accounting, guys, which we have not discussed because of the paucity of time. But even then, they are saying they have applied the derivative accounting, right? So let me move forward. Okay, derecognition. When I will derecognize the financial asset? Financial asset example, trade receivable. कब मैं अपनी बुक से हटा दूंगा? या तो मेरे को पैसे ही नहीं मिलने या मेरे को पैसे मिल गए हो, right? That means when the control has been transferred, when the risk and reward has been transferred, and the right to receive the cash has gone. So they mention their guidance. The company derecognize the financial assets when the contractual right to receive the cash from the financial asset expires, right? So then they will de-recognize the financial asset. Okay, then they have given the multiple disclosure that this is the financial instrument by category. These are the financial assets. They mention what is amortized cost. They mention financial asset at FVTPL, right? They mention financial assets and liabilities at fair value through OCI, and they have given the total carrying value here. And apart from this, they have also given the fair value in the disclosure aspect as well. This is for March 21, and they will also give for March 2020, right? They have also given for March 2020 as well, right? Then they have also given certain fair value hierarchy. This is coming from Ind AS 113, right? So these are the detailed disclosure, guys, which they have given in their annual report. And believe me, guys, and factually speaking, I am having some sort of confidence that you have gained some sort of perspective after attending a lecture of 8.5 hour session or a 9 hour session. So over to you guys. Any query, any thoughts, any comfort zone which you are having today? Because yesterday morning you were saying, sir, it's a very lengthy session, very complex going on to be in respect of financial instrument. I'm just want to have your perspective, whether you have gained some sort of knowledge, whether you have gained some sort of experience, understanding, because you have seen the concept, we have seen what is written in the annual report. Any thoughts? Any thoughts, guys? Any question as well? So Pankaj is saying, sir, we need to do self-study, then it will be clear. And my only suggestion to you, don't defer that reading. If you defer this reading for next 1 week, you will lose everything. At least read 1 hour, devote 1 hour on daily basis for at least financial instrument. And I can promise you, it is not a complex topic. It is only the matter of fact when multiple concepts gets into a one single query, it become complex. Otherwise, it is not. So one question Ashu has raised, sir, can you please tell how the interest is calculated in effective interest? Ashu, I have explained in very detailed manner in by taking an example in Excel file. Okay, you are asking which formula I have used. Okay, let me write on the board. So what I have done, I have taken is equal to IRR bracket start, and in this bracket, select cash flows. Right? This is the formula which I've used. I'm also tired, guys. Let me know if there is any further doubts. Happy to answer. One person is asking for hedge accounting guidance. Right, my only suggestion is first you go through the basic concept what we have read in these 9 hour sessions, right? Then you can pick up any book which is available in the market to understand hedge accounting. And factually speaking, very limited companies applying hedge accounting. It's not the case nobody is applying. people are applying, companies are applying, but in order to reach at that level, we should be very strong at our basics level. Okay, one person is asking for my phone number. Let me write on the chat box. ECL, one person is asking ECL, so it is about expected credit loss, right? We have very, very limited time, guys. It's very difficult to explain everything in these 9-hour session, right? But if you have any doubt, you can connect with me separately. I can provide you the guidance on that. Okay, guys, can we wind up the session now? One person is saying, sir, teaching on the board is very interactive and effective. Thank you so much, guys. I'm hoping you have gained something in these 2 sessions. Thank you, guys. Thank you, first of all, for your patience. And thank you for keeping this group interactive to making these 2 sessions very interactive. Thank you so much, guys.